joking around till after I go through my presentation, but we should have some time to open up the audio and chat. Also, I'll be keeping a close eye in the chat box for any questions as they come through.
You are live.
Okay, we're live, guys. Welcome to our April 13th trade alert. Got a funny cartoon to start us all off here. Cop says, "Don't even think about it," to Jesus as he's trying to come out. So pretty funny. This is actually what I think is going to happen with the so-called May economic turnaround, where we're going to turn back on operations in America come early May. In fact, there's quite a few revealing interviews with Bill Gates that have come out recently that would indicate that more likely is mid-June is when we could start thinking about things like that. It also does seem like Bill Gates is more in control of what's happening here than anyone else. So we'll take a closer look at that. The webinar teaser today is that the Trump team is telling the public to buy stocks. In fact, we had Goldman Sachs, JP Morgan, all the big boys come out after being extremely bearish 2 weeks ago, which is when markets were selling off, to suddenly now they're telling you it's time to buy, with Goldman Sachs flipping its prediction just this morning. The Trump team is telling the public to buy stocks and the economy will start opening up May 1st. There's no chance that happens. The death count continues to rise exponentially despite partial lockdowns. Partial lockdowns don't work. They're not the same as what worked in Italy. They're not the same that worked in China, and they won't work here. If they do open back up in May, it will be a terrible, terrible mistake. And I don't think that will happen. And don't forget, they've slowly tiptoed from telling us that this was not as bad as the flu to we'll be taking a 1 week break to a 2 week break. Now it's a 1 month break. We're seeing farms start to shut down. And so really what come next is quite likely. Please send an email connection. Okay, William, you should have an email link that's sent out an hour early also. So Ryan will make sure to get that too. I believe Bill Gates is deeply involved in whatever's going down here. He funded $10 billion to the WHO. We haven't heard Bill Gates criticize the WHO or China once. In fact, all we've seen him really talk about is how we must do a 10-week lockdown that's actually enforced worldwide, and then reemerge with masks until we get a forced vaccination to 7 billion people. So it sounds like Bill Gates got a little jealous with the Netflix subscription model and designed a setup here where he can ensure he's got every human being on the planet subscribed annually. Otherwise, you're not going to be allowed to work. They're going to create digital certificates, all sorts of nonsense. So very concerning. Remember the first time I did a speech as a little kid hyping up Bill Gates, know a lot about him. I've definitely respected him over the years, but his interest in this over the last decade is quite amusing to say the least. And we're also seeing a lot of moves in Africa between China and the Gates Foundation, as well as a lot of these different big wigs in the tech sector. So that's your teaser. For those of you who are in our boot camp, I do want to shout out that our spreadsheet's working and updating real time. So we actually have 4 spreadsheets now to track our returns, and it is updating real time, which is beautiful, huge time saver. So I'm going to get another day of testing out and probably release your spreadsheet Tuesday. We're going to teach you how to fill out your own spreadsheets this Thursday in the boot camp. So this does take you to the next level. And I will note that we have a unique spreadsheet now per track record. This way we can keep exact accounting for each track record. So right now our Pro Plus Boot Camp has squeaked out almost a flat return so far in 2020. We're down a little bit on our puts, but remember those puts act as insurance for 2 years. So if you average out a negative 5% return and divide that by a factor of 24, then that gives you an idea of how far that cost that's currently down could be spread out. And I still believe those puts will be the single highest returning trade for our portfolio, that you could just put those on, sit back, do nothing else, and have a great return. So although we have some downside in our put options today, for new people picking up today's trade, you're really going to have an excellent entry point to build our entire portfolio. So we're able to predict the stock crash well before it began. We've had some big gains in the TLT, some of which we captured, some of which we missed out on. The sell-off in the stock market and oil market this year was so vicious, it caught just about everyone under the sun off guard. Everybody was swimming naked with leverage. They've had to deleverage, and they ended up having to sell quite a bit of treasuries. In fact, over the last practically 4 weeks, the Fed has actually picked up $1.5 trillion of U.S. treasuries. So that's a big chunk of the funny money that's now buying back up the stock market currently. But I can assure you, $1 trillion won't cut it. $2 trillion won't cut it. In fact, I think the Fed would have to inject over the course of time of what's going to play out more like $12 trillion to support the stock market. And that doesn't count supporting the mortgage industry and the bond market and the credit market and the consumer and Boeing and on and on and on. So quite frankly, there's without destructing the value of the dollar, I do not think they can prop up the stock market, which has a value of somewhere around probably about 26 to 28 trillion dollars right now. So there's only 6 trillion in the balance sheet. If they put every single penny towards trying to prop up the stock market, that still wouldn't be enough if you got a few percentage of the population to sell, which I believe is in the cards. Let's take a look at our trade alerts. So on Mondays, we do publish 2 different trade alerts, but we combine everybody into one webinar. So this is our buy and hold portfolio, which I'll review currently. No changes to the portfolio. So my expectation is that we're going to break through the most recent lows, and then that's when we'll have an opportunity to buy some specific stocks, probably towards August. I'm thinking August, September will be an opportune time to buy stocks. So your buy and hold portfolio is short equities in the US, it's short equities in China, it's long gold, and it's long treasuries. Plus it has a little bit of cash, so about 16.6% in cash. The rest of your capital is highly optimized for further recession or bear market territory. So that's the position, and I, again, don't anticipate changing it. I do note that your concentration of assets will go up and down as different assets change value. So I'm not recommending a specific percentage holding each asset, instead a specific ratio per $1,000. So if you are following our buy and hold portfolio, which is great for accounts under 30,000, you can see our current allocation and track record right here. So again, you'd have per $1,000 with no rebalancing. So if you're down slightly on some of these inverse products, you don't change, just hold. So per $1,000, we have 6 shares of TEX, 1 share of FAS, 2 shares of Yang. Okay, TEX is inverse technology, FAS is inverse banks, Yang is inverse China. We have 3 shares of the beautiful 30-year treasury, the TLT, 5 shares of GDX, gold miners, and then again, some cash on the sidelines, some dry powder. So that's our portfolio. We're down 3% this year, but again, the S&P 500 is down significantly. We bought the downside about just under a month ago. So about 3 weeks ago, we flipped to a short position, had this massive rebound in the stocks. And you can see it's barely put a dent on our return. And I believe this will run out of steam. Probably by Wednesday of next week is when I think we'll start to see trouble for this current rally, which has a lot of good technicals going for it, but the fundamentals are obviously terrible for the foreseeable future. Okay, so that's your buy and hold portfolio. And again, we do combine everybody on the Monday webinar. So it does make it easy for everyone to follow this if they're doing the buy and hold, but also lets us rotate into the more advanced programs. So if you have greater than 30,000 to follow our strategy, we offer several other strategies. I'm going to scroll down to the track records first, and then we'll go into the trade alert. Okay, so this is what we just reviewed was our buy and hold portfolio. Had a beautiful return in 2019 with very few changes, and it's very correlated to our pro strategy, except without options. So the buy and hold portfolio, again, uses no options. It's very passive. It rarely makes changes, and that's our return currently. I don't anticipate any changes until sometime around August, when I think we'll hit a short-term low in the stock market for a good bounce that we could play. Talk about the timing and reasoning of that in a moment. The basic membership is a beautiful program that trades Monday, Wednesday, Friday, only US equities, and loves to trade the SPY. The exception is that in the current environment, I do anticipate a handful of companies really benefiting from all the stimulus being sold by the government, 2.2 trillion so far. And I see a lot of other sectors really struggling, being kept on life support just to keep our labor force from having too high of an unemployment number. So again, this one's great for a portfolio size that's less than 75, greater than 30,000, and it only trades US equity products. So we use options. Currently, this portfolio just has a set of put options and is in cash. So we've been telling investors to get out of the stock market since we picked up the crisis unfolding in January. Have a video with 20,000 views in February warning everyone what would happen, and continue to warn investors that a great stock market crash is ahead. And so in the buy and hold portfolio, we'll review that. Again, that just trades Monday, Wednesday, Friday, and it will trade US equities. And we'll review exactly how that portfolio is positioned. Now, as a bonus, until the stock crash does begin, I'm also covering the entry trades, not the exit, but the entry trades for our pro membership. So we have two variations of the pro, one's with the Bootcamp trades, one's without the Bootcamp trades. The Bootcamp will put on highly leveraged speculative option trades with a small amount of capital, and currently has 3 open positions. So we have a QQQ put that's doing extremely well for boot campers, shorting the market, not at the top, but near the top, and has until December. So again, we'll look for a bottom this summer to sell that position. We have a long silver trade, which is a 2-year leap that's doing very well. And we just put on our Hong Kong trade, or at least the instructions for it yesterday. So I have that officially in that track record. And this Thursday, I'll review how to do your accounting on shorting the Hong Kong dollar. That's a 10,000%. In fact, all 3 of those trades have return potentials in the 1,000 to 10,000% return. And we have to buy and hold these very leveraged options or leveraged Forex trades to hit those potential gains. We're using around 1% per position. So by risking no more than 3% of our portfolio in the Bootcamp, we can actually get some substantial profit in our portfolio with low risk. So we currently have 3 of those trades open, 2 of which, if you join today, you could still follow, one of which, the QQQ put, still is way too far in the money. So I wouldn't recommend that. Now our buy and hold, our pro portfolio without the Bootcamp is doing well. We're currently down primarily on our put options. And again, once you factor in the fact that those put options give us the insurance to buy stocks for the next 2 years, you can divide that cost out and realize we're not going to have to spend any more money on puts really for the next 2 years. So when you think of it in that manner, the drawdown we're seeing in our puts is not a big deal. Now, I do anticipate adding some positions next week to our pro portfolio, which would mean more call options on the TLT and potentially an optimization or a little bit of an increase to finalize our put option position. Okay, so let's take a look at the trade alert from head to toe, and I'll keep a lookout for questions as we go. Okay, so again, we're going to start off by covering the basic membership, which trades Monday, Wednesday, Friday. And this only has one task. We're asking you to stay in cash, which means don't own stocks, and to own this set of put options. So this is 5 different put options that have different expiration dates. And this is our current recommendation per $75,000. So if you had $150,000 following the program, you would double each of these positions. Now, if you're an existing member, you still should have the same position, no change. So for new folks, you're able to jump into these at a great discount compared to what you'll see reported in my track record. If you're existing, keep in mind, I have not made any changes. So this part of our portfolio has remained the same. These 3 I anticipate selling this summer when I think we'll hit a short-term bottom. But then my prediction is we will try to open back up the economy into July, and there'll be a lot of hope around this. Perhaps the Fed buying stocks, one thing they haven't done just yet. So these 2 I anticipate holding beyond this expected downturn, a bounce into Christmas, and then a bigger drop into 2021 is really what I see coming. And we'll talk about the reason why that is my expectation shortly. But just for expectations, these 3 will let go when we think we have a bottom in 2020. And then we're going to rotate into a set of ETFs that will be the direct beneficiary of all the stimulus that the government is currently bombarding our national deficit with. So if you thought last year's $1 trillion deficit was large, this year's is going to be gargantuan, and next year's will quite likely be even worse. So here's the ETFs. We're looking at healthcare, XLV, biotech, IBB, medical devices, IHI, e-commerce, ONLN, and aero defense. So we like healthcare and medical devices because of the current crisis underway, which is really, if you thought of it being an hour, 40-minute video that we're watching in terms of the spread of the current disease, we're no more than 1 minute into the flick. So we can do a lot of things to make sure the video doesn't complete playing, which is lockdowns. Pat says for new people, should they get the July instead of the June? No, Pat, I'm not changing anything. The current trades do a great job at giving us the downside risk. And the more changes we make, the more confused everyone gets. So I'm leaving those alone. If I were to adjust it, I would adjust it for everyone at the same time. So I don't want to have different people having different strikes, different dates, because it become, and that's one thing that's really nice about our program is that it is very easy to follow because we don't have crazy accounting, crazy positions, or crazy timing. Everything happens at the same time every day for everyone. So that does make life easy. So the bottom line is the healthcare, biotech, medical device sectors of the economy should have revenue growth and profit growth at a time where most sectors of the economy are going to have a huge drop in revenues and profits. Okay, so that's really anticipating that it'll be very difficult for the US to maintain its lockdown for longer than what I anticipate being mid-June, and then it'll be forced to go back and reopen the economy. And so from what has already occurred and what's going to occur, we can expect massive costs hitting the healthcare sector and medical device sector, and that these costs will be funded by the government. So we've got trillions of dollars being sold at the Treasury, and I believe that will continue to grow and be directly handed off to primarily XLV and IHI. Now, in the same breath, the world really desperately needs a vaccine to really solve this problem. Because without a vaccine, this is going to continue creating a huge amount of deaths and more importantly, a huge percentage of people who lose capacity to breathe and end up with low oxygen levels and thus need a ventilator, an ICU, and tremendous healthcare costs. So those three really make sense in terms of following where the money is going to go and who's going to have revenue growth and profits at a time when everyone else will be really having trouble. Now, e-commerce, I think, will also perform relatively better than other stocks. But again, what's important is that in this chart, you can see the SPY and the candlestick, green and red. The other ETFs, you can see, are highly correlated. So we still need a reset in pricing before entering these positions. And if you assume that we're going to have somewhere around 20 to 30% unemployment for quite some time, that all companies are going to dramatically cut costs and have to repurpose their corporation to make sure it actually is viable and creates profits. Well, I do believe that the entire market is currently dramatically overpriced and that there will be a much lower repricing on all equity assets. So there's nothing that's occurred that should lead one to believe that profits and earnings are going to remain healthy in 2020 and 2021. Absolutely no case for that. But relatively, I do believe the sectors we've highlighted will outperform their peers. So after a big crash, these are the ETFs I think will just rocket higher, at least for the short term into Christmas. We'll take a look at predictions. The other big prediction is that we're going to be at war with China and Russia as a key selling point for the November election. Now, I don't think we're going to be dropping bombs or anything of that nature. But what we have seen is the government does continue to grow its budget for military year after year. And I think that this will be a very sustainable trend and a huge benefactor of all the stimulus. So we can see in the purple ITA, primarily dragged down by Boeing, that this is going to be our biggest value play, even though they may have some quite considerable problems with their company. But indeed, this August, September, to pick these up I'm hoping for 50 cents compared to what they were trading at their top. So at least a 50% correction to want to jump into these positions. Now, again, we're going to have put options, which hedge us into our equity positions. And our initial entry point won't be to just simply buy the underlying assets, but instead to sell puts. And then if the put goes in the money, we just keep the premium and fill the position. That'll be our entry point. So we'll be able to jump into that position and near the same period of time, let go of this top three put options. So that's really our 1-2 punch to get into this positioning. Now, I do like to use the analogy of a house. The put options are your cement floor. And again, that's really going to last for 2 years. So this is a 2-year investment that we're going to sit on and hold as all this really unfolds. The cash in your account acts as the walls. The walls are going to be replaced with cash into these ETFs. But again, I think the timing will be somewhere around August. And that anticipates that we do the recommended global shutdown for 10 weeks, recommended by Bill Gates, and then reemerge with masks and no big public gatherings. So even though the economy will reemerge, I don't think we're going to be going to sports games this year. Don't think we're going to be going to gyms. I don't think we're going to be going to movie theaters. So really public gatherings where you don't have to wear a mask will quite likely not be reemerging until there is a vaccine. Okay, so that creates your floor, your walls. Let's talk about the roof, the electricity, and the plumbing. The Pro membership trades every Thursday. And again, I'm giving you the entry trade alert, not the exit, as a free bonus until the stock market crash has really started to unfold for us. So this will help you complete creating your full house, as our analogy runs. Okay, the bond market is your roof. We've been long the TLT since this program began, and it's been very, very, very beneficial. In fact, if you go look at the yield in the 30-year Treasury over the last 4 decades, with very few exceptions. It's just slowly but surely grinded lower and lower and lower. In fact, every single time the Fed has cut rates dramatically towards zero, a recession has played out immediately after. The TLT has gone up and stocks have crashed. So I don't believe this time will be any different, although they have come in with QE and rate cuts at the same time. So that is potentially going to slow down this outcome. But again, without literally handing over $12 trillion to buy up half the stock market, I don't think it'll be enough. So we'll take a look at that more in detail. In our pro membership, these are only long equity positions. Currently, we have 200 shares of the TLT per 75,000 following, and we have 400 shares of GDX per 75,000 following. Now, we don't trade naked. A lot of people like to trade naked because they get better returns. They get better returns until the market trend changes. When the market trend changes, they get massive, massive losses. So we have a very low volatility return with very little drawdown because we always have downside protection. So in this case, we have the married put strategy under both of these. On the TLT, we're doing a weekly put option. So every Thursday, I'm buying a cheap put option, which I hope expires worthless, because if it expires worthless, that means my TLT shares have gone up in value. So if we think that the immediate move on an asset is up, then I want to buy short-term protection and roll that protection every week. So this Thursday, we'll roll this to the next Friday until, again, I think we'll be calling a short-term top on the TLT somewhere around the 178 to 180 level. And again, that's where it popped up to, and then marked where we had a lot of turmoil in the market. So I would expect our puts going up at the same time that we can call a short-term top in the TLT. Now, these positions we want to go up in value, and this is 4 different TLT call options, which are all a buy recommendation today. And we'll be letting go of this TLT call option this Thursday, and then hanging on to these until into future weeks. So I don't anticipate selling these for quite some time. And again, not this week, but next week, I anticipate us adding a few extra TLT call options to our position and potentially buffering up a little extra exposure into this set of puts. So for this week, the only trade I do anticipate us making will be to roll this TLT put and to sell this TLT call, just to be really clear. And then next week, we'll look at expanding these call options and then potentially boosting up these puts slightly. Okay, so let's look at what else we have. GDX also has the married put. Now, unfortunately, even though everything about the gold mining industry is beautiful, there's a fight over the hard assets of gold. Oil prices are cheap. Money printing's at all-time highs. I still think that GDX can see downturn correlated to the S&P 500 in the next big move down. So we have locked in the gains we've recently had in GDX by purchasing a $28 GDX put expiring 8/21. Now, I do anticipate we'll sell these puts probably right before we sell these puts. And then we're going to just remain long our gold miners. So every quarter, I do expect us to slowly but surely, gradually increase our risk in the gold miners. Currently, that's about 12% of our portfolio. And I love gold in this current environment. The risk with gold is that the central banks really don't want people to own gold. It doesn't help the economy. It does not help their agenda. That's what they want to own, not you. And so they can easily manipulate the price of gold. In fact, there's lots of court hearings where JP Morgan has people being indicted for just that. So we know that GLD ETFs, more like a fractional reserve. So they have one tenth the assets under management in terms of hard gold. And JP Morgan, HSBC constantly have a short position against everybody betting up on that asset. So, they can easily sell gold in a short period of time, create a dip, create selling, and then buy it right back up. So that's the big risk of playing the gold market for the foreseeable future. And we'll be looking at every drawdown in the gold market as a buying opportunity to sell our puts and then add risk. So we've seen gold do well, but I still think it lives in the stock world and will be sold systematically with other stocks at the same time. Okay, other positions we have open. This is not a recommendation today because it's already deep in the money, so you'd be taking on a lot extra risk than I am. But we have a highly profitable put option on the emerging markets ETF, which again is China, South Korea, Hong Kong, Russia, India, a whole smorgasbord of countries, ex-Japan, so no Japan in that ETF. And I do anticipate us having to try to sell that one soon as we're running out of duration. But it is in the money, so we do want to wait for the next dip to get out of that position. Now we've upped the ante with a new concentrated position, FXI. FXI has been outperforming all of its peers in the region. That's the large cap Chinese companies. And so China's done a great job, at least according to themselves, of slowing the contagion, at least internally. They've done a great job of also manipulating the WHO and covering up what was happening for months. And so despite their ability to potentially have a better government, yes, MR, this is live. How's it going? China's done a good job in terms of being able to lock its citizens into their apartment buildings, let them die without medical attention. They've told everyone if they report any cases, then they can't go back to work, so they're all starving. So they've done a great job at being able to control the data and the narrative. My expectation is the U.S. going to be pissed that they were lied to and that China really deliberately let this spread worldwide and has continued to cover it up. So I expect sanctions of a numerous variety hitting China in the coming weeks and months, and for this to be a really big selling point for the election. So the trade that is open for new folks is, and this is already up, I think about 10% for us currently, is to own for every 75,010 November 20th, 31 strike FXI puts. So one move the US could make is to either restrict capital flows to products like FXI. So pension funds, retirement funds, every money manager, they're just secretly taking cash out of America and funneling it to Chinese companies, which have no auditing rules. So we get a little, it's called an ADR, a little 5-page printout from China of what their profit loss is. And then we have to trust that it's the truth because the Communist Party says it's top secret, any data in terms of counting anything inside China. And that's again, because they want to keep everything about how they manage their government, who's really in power, top secret. So we've seen countless fraud come out of Chinese companies with bad data. So again, because of that fact, I wouldn't be surprised if we completely outlawed all investments into these products because China will refuse to allow us to do proper auditing. If that's the case and FXI goes to zero, we paid something like $1 for each put, which the seller of that put will keep. And in return, we're going to get 31 bucks. So you invest $1 and get up to 30 for that trade. And that's if it were to go to zero. That would be the best outcome. If it goes to, say, 15, then we can get $15 for every dollar invested, approximately. So really quite a sexy trade right there to short China if you do believe that the tune's going to change on China. And we've actually seen that slowly but surely become the case. Okay, so that's a good review of our full positioning. Let's take a quick break for questions. We're up to 90 live, so welcome everybody. And I'm going to start off with just chat questions to start before we do any audio, as I do want to look at some other data first.
And if you guys want to talk, go ahead and raise your hand and I'll get you unmuted.
Yeah, Ryan, I just want chat questions to start before I finish my content.
Cool.
Ron Brooks, why is the TLT so sluggish? Okay, we'll cover that when I look at the treasuries. Amar, what is your trading plan for the next few months? This is it, Amar. So this is really set it up and kick back, and you're going to do really, really well if these predictions are correct. Okay, great. Let me go through some more content. I am keeping a look for questions. After that, we'll raise hand and open up audio. John S. says, is there replay? Yes, sir. So if you go back to your email after the webinar is over, click that. It'll replay this from the beginning. Okay, so I'm going to go through a high level now and fundamentally explain the thinking of our trades. And from there, we can look at charts, news, and then I'll finish up by opening up audios from anyone who wants to talk live. Okay, guys, so let's take a look at this. This is a really important chart right here. This is called the federal funds rate. Okay, so the gray lines are the last several recessions we've seen since 1955. And so a lot of people give the Fed, okay, Marlene says, I'm not sure what I should do with 30K. Yeah, so I would either do the buy and hold or the basic membership, Marlene, and Dean can definitely give you a call. So Dean's your go-to guy to help you figure out which product to follow. I would do the
she did basic on Thursday.
Oh, okay, great. Well, I would be following the Monday, Wednesday, Friday program. Absolutely. Only, and not the buy and hold, Marlene. So you'll have a great entry point and be ready to buy up stocks this summer for cheap. Hopefully half off, maybe more, but okay. So let me go through this. So this is the federal funds rate. The gray lines represent where we had stock crashes and recessions. And you can see without failure, what's the Fed able to do in just about every single stock crash? They cut rates. And in fact, they start cutting rates before the recession and stock crash begins. Funny enough. So here's a crash. You can see they cut well before the crash began and recession. They cut before this one. They cut before this crash. They cut before this crash. So you'd almost think that cutting interest rates causes stock market crashes. Well, what if it does? What if it would have crashed even worse had they not? But by cutting rates, it actually incentivizes investment into the bond market. So that's what we're going to take a look at here, guys. Okay, so what have they done recently? Well, they've cut rates to zero, and we started to see a stock market crash. Okay, so let's talk about the big picture here. Okay, so what we have up on the screen is the SPY ETF and the TLT ETF. TLT is your 30-year treasury, and the SPY ETF is the S&P 500. And so what I first want you guys to recognize is the simple relationship. Okay, so in this chart, we can see in 2008, stocks crashed for just about a year. And what happened to TLT? It spiked. So TLT went up 46%, and the stock market crashed about as low as from up here to down here about 50%. Okay, so if you were just simply half invested in stocks, half invested in bonds, it wasn't the 30-year Treasury's yield or interest rate that made you money. It was the bond value going up. So when we buy bonds, it's not because we want to collect 1 or 2% a year. It's because we believe interest rates are going to go lower. And that's really all there is to that investment, is that you believe that the interest rate will go lower. So we're going to talk about the mechanism that makes that possible for banks. Okay, so we can see almost without failure, if stocks go down, TLT goes up. Okay, stocks go up, TLT usually doesn't go down all that much, but it doesn't go up. It's almost exclusively when there's downturn in stock market, you catch these rises in the TLT. Okay, so that's why so many investors like to have a bond stock ratio like we do. Okay, so that's first thing we need to understand. Let's go back to this. So why does the Federal Reserve cut interest rates to deal with the recession? And why do we always get a stock market crash when that happens? Well, let's talk about what's really going on. So if the Fed cuts the rates to 0, that allows a small group of banks, JP Morgan's the biggest in terms of taking advantage of this, to borrow for free. So right now, interest rates are practically at 0. Okay, what's happening in the Treasury market? So JP Morgan actually by law has to buy this debt being sold by the Treasury. So this is treasurydirect.gov. And all it does is it shows you all the debt being sold that's currently scheduled by the government. And so if the government can't collect taxes to pay for its debts or its spending, it has to sell treasuries. So JP Morgan has to sit here and they have to buy all this debt. But guess what? The amount of debt we're issuing is far greater than how much capital they have to buy it. So if they sat there and bought all the debt without help, JP Morgan's balance sheet would be frozen probably in a week, and they would run out of money. That means you wouldn't be able to transfer money from bank A to bank B. You wouldn't be able to pull money out of the ATM machine. The whole financial system would collapse. Okay, so if they can borrow for 0 and then turn around and buy the debt, it's a different game. So let's look at the yield curve here. The deal that JP Morgan gets is not that they have to use their own money. In fact, they get to borrow from the Federal Reserve. Then, which is 0, they can turn around and buy up all this debt. So right off the gate, they've got a pretty sweetheart deal. Borrow for free, buy treasuries that have a positive yield. So right at that point, they have nothing to lose. Now, after they've done that, they could go sell this into the open market. But in fact, they are not. They're hoarding these treasury products. So you got to ask yourself why. And so what happens is that this is then sent to the repo market. Go to our life cycle here. Okay, so step 1 is primary dealer borrows from the banks for free. Step 2 is they buy up US debt. Step 3, they then take the debt and they give it back to the Fed. So if you've heard about repo, that's what that's all about. Now, once they give it back to the Fed, it's just like a placeholder. So the Fed's going to give them cash back. So their balance sheet's actually expanded by taking on these treasuries. Now they have new cash, which they're going to turn around and lend to broker dealers. So step 1, they borrowed for free. Step 2, they picked up a guaranteed profit from the yield of the treasury. Step 3, that wasn't enough. Now they're going to hand it back to the Fed for repo, and then they're going to get cash. With that cash, they're going to turn around and lend it to broker dealers. Broker dealers can then turn around and lend it to a number of people, everybody from Ray Dalio, who does leveraged stock bond strategies, to every hedge fund using leverage, to every retail consumer who's borrowing from their broker dealer. So this is definitely creating a lot of liquidity for whatever investments people want to make outside of what the primary dealer is doing. Now, as all this is happening, the Fed has even come in with QE. So if the bank, for whatever reason, wants to sell some of these treasuries because they've shown a profit, then they can sell them without any risk of interest rates spiking because they've come in with QE. Now, I do want to point out that typically the scheme that works here is that essentially we create a problem in the private sector that's so large that banks can't deal with it themselves. So normally a bank loves to find a distressed company because they can go loan it a convertible note. The underlying party fails to make good on the note. They convert that note into a huge chunk of owning your company. So banks love to do that. But when we get a problem that's so great that a single bank can't stomach it, then we have to use the entire US government to do the same scheme. So let's just talk about the 2008 crisis. Banks went out and loaned capital to really minorities who shouldn't have had a loan for a house. That was really the big mistake they made. And it was about $300 billion in loans that were actually showing a high level of mortgage payment delinquency. And if it was just $300 billion, probably wouldn't have been a financial crisis like we had. But they took that debt and they packaged it into bond products that took a bunch of loans into one loan, repackaged it, leveraged it, turned into about $3 trillion worth of bad loans that had been sold. They bribed different credit agencies to give these a AAA rating, and then they went and sold this to the public. And so when those underlying 300 billion in mortgages started to hit about a 20 to 30% delinquency rate rating, that's when this all came spiraling out of control. So how did the government deal with this when the banks couldn't? Well, the idea was, all right, the government's going to have to bail out this industry. And to do so, they're going to have to issue a whole lot of debt. So they cut rates to zero. They started selling debt. The big banks bought that debt, and there was no QE. So the banks actually had to buy and hold the treasuries until the underlying problem had been solved. So they're still able to borrow for cheap or free from the Fed. They still had to sit there and buy the treasury debt. But in this case, they made the banks wait until the problem was clearly resolved. The losses had been absorbed. And then they opened up QE. So this is when they typically do QE. And that allows the big banks to sell those bonds for a profit, not to the open market. And during this period, usually stocks crash because all the capital knows they're going to get a guaranteed profit from the bond market. The banks flip the bonds to the Fed and buy up stocks for cheap. And then you get your stock market recovery. So to summarize, you end up with a problem that no bank can handle. The government must handle it. So the government has to expand its debt. They do this by cutting rates to zero. The primary dealers have to fund that debt, but it comes from the Fed. And then at the end of the problem, typically the Fed comes in and allows you out of those bonds for a big profit. And that typically marks the bottom in the stock market. So this time around, the underlying problem's much greater than 300 billion. So far, they've extended about 6 trillion in credit in a month. And I don't think we're even near the end of extending credit. So right now we have $2.2 trillion that has to be sold from government stimulus package. They're probably going to come in with another 2 trillion infrastructure plan. And so what comes next is all the money in the world is going to have to be forced into buying these auctions so that they can fix the underlying problem. And this in itself is going to be a massive vacuum or magnet for capital. Because why go risk your money in a stock product where you know profits and earnings are going to be collapsing for quarters to come, when you can invest in a treasury product that really, it only needs one thing. If you buy treasuries, you're expecting the government is going to grow its debt at an accelerating pace. Because if they grow their debt at an accelerating pace, yields must drop so that this whole scheme works. Otherwise, everybody holding treasuries gets out. So that's really the big picture in our whole portfolio. And anytime you see a central bank cut rates to zero, it's really bad news for stocks because it essentially guarantees profits in the bond market for those who understand the mechanisms. Okay, so let's look at the TLT. Okay, so if we look at the big picture on the TLT, again, we're not interested in the yield. We're interested in the value of the bond. The higher the yield that you collect for 30 years, the lesser the value of the bond. So if we buy at a high yield and then the yield drops, the value of the bond is going to appreciate. And that's really what we're expecting here. And so as long as the government wants to expand its deficits at an accelerating pace, they absolutely have to ensure this occurs. Otherwise, trillions of dollars holding US debt is going to be underwater. And so that's really your big picture on the TLT, and that's why it's such a critical piece of our portfolio. So we have a question. Let's see what we have. Ron says, why is the TLT so sluggish? So, okay, so great question. Why is the TLT taking its sweet time? Well, keep in mind, they haven't even sold the debt yet. So here's what the scheme is currently for us to fund this $2.2 trillion. Right now, the Treasury has more money in its coffer than it's ever had, I believe, in quite some time. And they haven't, as you guys know, we watch the auctions daily. So the 30-year Treasuries only sold once a month at the front end of the month. And they just did their normal $18 billion in April. So they have to slowly but surely move $2.2 trillion of debt out of the T-bills, which the Fed just buys itself primarily, and move it into the notes and the 30-year Treasury. Because what we don't want to have to do as a government is refinance a fresh $2.2 trillion of debt every week. In fact, this is rotating and selling every single week. So most of the debt is held in here, but their goal is to push it to the 30-year Treasury. And they're also going to add in a 20-year Treasury. So if they haven't slung the debt yet, then there's no incentive to push the yields lower. So really, I expect by next month, we're going to see the size of the 30-year Treasury auction start to dramatically grow as they rotate this debt out of the front end of the Treasury curve towards the long end. So let's just look at the yield curve over the past few months. Now, entering the year, we thought that we were going to have the exact opposite trading opportunity. Stock market going up, healthy earnings, GDP growth, no political tensions between China and the US, and that because of that, the money would be attracted to the stock market and not the bond market. So we actually had the exact opposite setup going into January, as did most smart, top-notch investors. Almost everybody had that exact same forecast. And then what happened? The Chinese stock market was crashing when the US market was rising, and it made no sense whatsoever. And that's what got us figuring out that there'd been a epidemic breaking out in China that probably began earlier than November. They were having tons of cases in December. They covered it up in January, and now we're in the world we're currently in. But look what happened. Right away, the bond market figured out something was wrong. Inverted yield curve. Fed does not like an inverted yield curve. This messes up the bank strategy for playing the Treasury market and for playing the loan market. So they really want this to be a nice, healthy curve like we have currently. So what did the Fed do? They cut rates with an emergency cut, and they began aggressively buying the front end of the Treasury. So you can see we started off with this inverted yield curve. By February, it was extremely inverted. And then what did they do? They came in and dropped rates over the period of 3 weeks to zero, and they've just massively bought all the debt in this in the T-bills. So they've dragged this to nearly zero, and we can see our product that we play, the yield's been slowly but surely dropping. So my anticipation is they want this to last as long as they have to take to sell the debt, so that there's a carrot on the end of the stick. We want the big banks, the big central banks really outside of the US, to buy this debt and to hold it until the crisis is over, before we have to buy it back from them for a profit. So again, our expectation is a sudden vicious crash in stocks and a slow, steady rise in bonds. The money that has to be raised by the government will take a long time to raise. So we can shortcut some of the spending by just ramping up the T-bills, which we did see them do, but this has to get rolled over every week. Really, they want to get it one and done in the 30-year product, and they want that to be at the lowest interest rate possible. So I believe as we gradually start to sell more debt on the 30-year, you're going to see the Fed is going to pull back the QE. So to really push money into the bond market, they're going to have to cut QE. So we have seen them gradually drop the QE per day every week. So that is their intention, is to stabilize the markets, cut off the QE, and that will force everyone to buy and hold the debt. So I think that's what you're going to see come and cause all this to work perfectly for us. So if they cut QE, that's terrible for stocks, and actually will force everyone to buy and hold their debt products. So that's what I see coming for the bond market. Okay, Jim Wills says on FXI, why a strike of 31? My urge is to buy a higher put. Care to share your... okay, let's take a look at that FXI trade. Okay, we're up 8% on that one so far. And so just to be very succinct with the answer on this, Jim, I was expecting FXI could crash somewhere around 50% as a minimum. And so if we didn't get the absolute largest payout, which would be this going to zero because it's just straight up removed from the stock market, then this, it really has the best of both worlds. So if we get a 50% crash, this will go by that by double. So this was picked to be perfectly in the middle of where I think our maximum drawdown might be on FXI by this summer. So my anticipation is to sell this sometime around August. Lots of time premium, and hopefully it's trading around somewhere around, I think it could go as low as 20 if there's no actually removing it from our stock exchange, which is an easy move we could do. So that one has a good risk to reward, whether it's just a crash or whether they actually outlaw it. Pat says, how will the Fed flip the corporate bonds they're buying today? Who will they sell them to? Yeah, that's a good question. I don't know. They may just never sell them. I bet they just hold those indefinitely. So free money for, considering the extent of the problem we're facing, there wasn't time to try to pick out who's a good actor, who's a bad actor, who should we let fail, who should we let. I think their goal was to just create a systematic pump that would slow the bleeding, and that worked. Now, will it be enough to completely stop a pullback in stocks? I don't think so. Not without far greater expansion of the Fed's balance sheet, because they've only added $1.5 trillion to their balance sheet. They did that only by buying treasuries primarily. They bought some corporate debt, but mostly, and some mortgage-backed securities. But you can't protect the real estate market, the bond market, the stock market, and the dollar at all times. Not when you're having a huge economic punishment. Okay, Logan says, I found it interesting that you gave approximate timelines for the SPY, such as a potential peak by next Wednesday and temporary market low in August. How are you able to provide consideration? Sure, let me give you my best estimate. So I don't pretend to have a crystal ball. I use fundamental analysis primarily for that, Logan. So no technical trends for that. Now I do like to listen to technicians. I think they're good at finding levels. I don't think they're good at picking direction necessarily. So what's causing all this drag on the economy? Well, obviously it's shutting off businesses and forcing everyone to stay at home. It's creating unemployment to spike. And it's also obviously going to change consumer spending, and none of which is going to increase profits and earnings. So the entire rally we've had right now would really have to be sustained, would have to argue that really the worst is behind us in this problem. Okay, so this is what has been miscalculated this entire year and been the opportunity to make money. And so we always talk about, if you can find something wrong with the prevailing opinion of the public, then you can find a discrepancy and opportunity. So right now, the administration's pitching that we're going to open back up in May. Don't forget at first that we're going to be open by Easter, and this slowly but surely changes. But the news flow right now is that, hey, we're having cases slow down in New York. The new cases coming in are slowing down. So they're all pitching that we're going to hit a peak in necessities for hospital systems. In fact, that we've already passed the peak is what they're projecting in this model right here. And so I believe that's completely incorrect. So here's the basic facts about this disease that is causing the shutdown. And if we study that, then we can have a better idea of when economic turmoil may be completed, and we can actually start to see a recovery. So the problem is that essentially children catch this disease asymptomatically, meaning they have no symptoms. In fact, they may not even know they've ever had a cold whatsoever. They can carry this disease in terms of being able to breathe it all over the place, including in their urine, their feces, exhaling, their hands, their shoes, everything. They're just covered in it. So they're all out. They don't want to stay home. There's little gangs of them running all over the place at this very moment, spreading the disease. And that's been the case probably since as early as Thanksgiving in the US, is that we've been seeing this spread since Thanksgiving, not since January or February. So it's been here far longer than we understand. So that's one. Two, it looks as though it can infect about half the population with a lot of case studies. You can go to a lot of different small areas where people had to share similar space, and we're getting about half the people to end up with the infection. So it spreads without symptoms, no fever, no cough. You can have it breeding in your body, spreading for weeks at a time. So that's the number one problem. The number two problem is that about 20% of the people who do catch it, regardless of age, just total accounts, are ending up with low oxygen levels. So in some cases, it's from the lungs collapsing. In other cases, we just don't know what exactly is happening. But there are cases of people having low oxygen levels without the symptoms in the chest. So this could be more complex how it's taking people out than we actually understand. But because of those two simple facts, you realize that there's really no solution that doesn't end up overwhelming the hospital system and creating panics. So we've been able to date, there really has not been a slowdown in the total deaths. So I do believe we're miscounting deaths. Um, Only the most obvious are getting counted, but we're surely not testing the whole population. So for them to sit there and say the new case incidence slowed down, I think is completely inaccurate. And really, I look at the deaths as the best leading indicator. So I believe this is the hardest to hide because at least people with any money whatsoever, and now that we have education as to what's spreading around the world, people dying are demanding this test happen. So this is your best leading indicator that the world's taken the right precautions to actually slow down the spread. And I'd argue that to date, we have not created those precautions. So I believe come May, the death count will have grown rapidly and that we will not be opening back up the economy. So that's one thing I'm forecasting that is not priced in. And so my anticipation from studying this is that the only solution that works is a 60-day lockdown, is what I've been saying. Although Bill Gates has been pumping, and I've been saying this before Bill Gates came out on his all these little interviews with CNN, BBC. He's been pitching a 10-week lockdown that's worldwide and comes out with a forced vaccination afterwards for 7 billion people. So really the calculation is that we understand that this is at best infected a small percentage of the population. So it's nowhere near being completed. It spreads asymptomatically. So there's no way to stop it without just keeping everyone locked into their homes. The current lockdowns have been quasi-lockdowns. We still see people getting into big gatherings at Walmart, Smith's. So really, I wouldn't count any sort of lockdown we've done as something useful for slowing the spread. The percentage that do get this, a huge percent end up having to go to a medical facility for specialized treatment. And when you look at the population of 350 million people, you realize that probably half of those are at high risk of being infected over the next 12 months to 24 months. Then all of a sudden you're looking at tens of millions of people who are going to need ICU and nothing short of a couple million who potentially pass away. Now, that's if you just let it rip through society. So I actually think we may get a smaller stock crash if they just let it rip through society, but it would cost a couple million lives, and you'd have to somehow deal with 10 to 30 million people needing ventilator ICU. So that we just don't have capacity for, and that's why you can understand they just cannot open up the economy fully, because it would just rip right back through. And this would, instead of slowly growing, it would be just skyrocketing straight up. Okay, so that's really the calculus. My calculus is that we're going to have to do a lockdown into mid-June and then reopen the economy with everyone wearing masks at a limited output. So if we think about timing, what are all the factors? What are the catalysts that are going to cause a big sell-off? So with all the funny money in the system, they can easily absorb a few $100 billion in selling a day. It's really when you start getting 300, 400, and 500 billion in selling orders a day that this becomes too great for all these big players to absorb. So Q1 earnings probably won't be blowout, but I don't think they'll be too egregious. Now, earnings projections coming out probably will be quite weak. The earnings that come out from April, May, June, and start beginning to be reported in July, I believe will be far worse than what they've expected with their new earnings projections. And then the quarter after that, from July, August, September, should be extremely dismal. So I do anticipate that we're going to have, just from earnings data alone for the next 6 months, we're going to punish stocks to new lows. And again, my entry point where I think we'll have peak panic will be some point in August or September. Now, the catch here is if we keep everybody locked down for too long, then this outcome is absolute. Everybody's going to go bankrupt, and we all starve. So that's not really a solution. So at some point, they will have to open up the economy and realize the spread will resume. Now, if they do this in May, they will have achieved absolutely nothing. This is just going to skyrocket right back out of control, and they'll have to do the lockdown probably by July or August. So I really don't anticipate anything opening back up in May, and believe that's going to be the first big letdown for the markets. So that's one big catalyst. A second big catalyst is that everyone becoming unemployed, or anyone who has a small business, or anyone who's passing away, is going to have a large incentive to liquidate assets, reduce costs. So that means selling stocks, selling real estate, and firing employees. Downsizing. Okay, so that's going to be a trend for the next 6 months. And then the third big catalyst is, I believe you're going to see the administration blame this all on China and begin to place sanctions against China, one of which could be to revoke Hong Kong's special status, and is a beautiful setup for a Hong Kong trade. So those are really the three big forces that I believe are going to punish stocks. And so my hope is that we can get a bottom in either August or September, as we've had a few months of getting people back into the economy, opening up some of the businesses, and a much different repricing in what we value stocks at, which has to be much lower because there's no way we're back to normal anytime soon. And at the same time, we have a investment setup for banks that is essentially a guaranteed profit if you buy bonds, and a total crapshoot if you buy stocks. I mean, if you buy stocks right now and really think that the worst is behind us, it's a huge, huge gamble. So in the stock market, you know that you have at least no less than a 50% risk from here. And trying to trick yourself into thinking we might stabilize these prices and go back towards new highs and wait it out for 2 years seems quite foolish. So I think any sensible investor understands that the smart investments, bonds, which you just rely on the Fed lowering rates and doing QE to get a payout, makes sense. And that if the government's expanding its debt, that's really something that has to happen. If it doesn't happen, the government's unfunded, and this all really deteriorates regardless. So really, if the TLT doesn't go up, that ensues that the government did not sell its stimulus, and that the stock market crash rallies really nothing to support it whatsoever. So that's really the logic behind that. And again, when we do buy stocks, Logan, we have puts underneath. So we're going to have a hedge to protect our portfolio to put that position on. We're not going to be buying it naked. Okay, let's see what the next question is. JD says, are you looking for the trades? MR, is the dollar likely to crash? Okay, great question. One of my favorite charts. No, not in the initial reaction. My prediction is the dollar will be a great leading indicator for the stock crash. So every time the dollar index rises, that signals that emerging markets are struggling. So this is DXY, which is a basket of different currencies against the dollar, and it does include some emerging markets. So it's not just against the euro and the yen, the two other big pairs, but it has a whole smorgasbord of different currencies in there. So yeah, my expectation is that how is the U.S. stock market doing so well right now? Well, essentially, we said, all right, guys, the U.S. has more outstanding government debt in total dollar terms than any other country in the world. So other countries have bought our debt and held it. One, because it's been a great investment, yields always go lower. Two, they have a lot of their own debts and costs that they have to pay for in dollars. So owning the treasury products, beautiful. Not only does the bond appreciate over time, like clockwork, one. Two, they get free money every year, which they can use to pay costs. And so because it's been a very popular trade by central banks worldwide, as well as just big traders worldwide as well. So what happens when the dollar index goes up? Why would it go up when we're all of a sudden expanding our balance sheet by $1.5 trillion? So the US basically said, all right, we know you guys own a lot of our debt, but we're going to go ahead and devalue your debt by printing $1.5 trillion that don't exist. It's not from taxpayer dollars. We're just going to create it out of thin air and come take out anyone who wants to get out of their debt product today. We're going to pick that up. So we can see that move right here. This is where the Fed essentially let anybody who needed out of their debt to exit one big swoop. And we saw this huge move down from 180 to 140. And between here and here, the Fed has picked up $1.5 trillion on their own balance sheet. So that was just funny money printed out of thin air. So that should be devaluing the dollar, but it didn't. Okay, so the dollar barely budged and now it's starting to rise. So what that tells you is that emerging markets are struggling. They're having to sell their currency for dollars to fund their short-term liabilities that they have to pay for in dollars. So some of that's interest on their US denominated debt. Some of that's just buying oil. Most trade, almost all trade is done in the dollar. So there's just a massive, massive demand for the dollar. And so my anticipation is actually that the dollar rises and as emerging markets continue to struggle. So let's talk about what causes emerging markets to struggle. Well, if China slows down, China's been the growth engine for emerging markets and really the world. Well, China shut down their economy for 3 months. They're barely starting to turn it on. So their demand for importing goods from their trading partners is going to dramatically drop. Okay. If their demand for imports is going to drop, their trading partners are going to be hit hard. So emerging markets are feeling the pain, and we can see that in a strong dollar. So as emerging markets continue to fail, what do they have to do? Well, they're printing money in their local currency. They're converting it to the dollar, and they're also selling assets. Now, which asset are they more likely to sell? A safe treasury that's literally guaranteed by the Fed to make money over the course of time? Or are they going to sell their risky equity position that really, if you think about it, is overvalued and really doesn't have any signs of increased profit and revenues for the foreseeable future? They're probably going to sell. Their U.S. equity position now that it's been popped up to cover those costs. So, what would take down the dollar would be to pop the bond bubble. And what's going to pop the bond bubble will most likely be the Fed raising interest rates because of inflation. And I think that's going to take quite some time to play out. So right now, the drop in demand because of unemployment, I think, is a greater force than any inflationary pressures we have. So right now, I do believe that the dollar rises and the bonds rise, stocks crash, and gold's going to be starting to get some early birds picking at it, but it's still early. Okay, Sue L says, should you buy healthcare right now? Let me pull up that comparison chart. Okay, so great question by Sue. Should we buy these now? Let me pull up the exact question. Okay, Sue says, should you buy healthcare and medical devices now when they're in high demand? Thank you. No, so we got to realize that, stocks are valued based on their profits. So you're really taking a share of their profits into the future. And really what you want to do with stocks or predict a growth of profits. So not just a steady profit, but a growth of profits. That's how you can make the most money in the stock market. Now, conversely, if you want to buy a bond product, you want to expect that they're going to be able to pull off a growth of debt. So not just the same trillion a year in debt. We want to see the government's jumping that up rapidly. So without question, the government plans to dramatically increase its debt. And luckily, that's guaranteed to occur because our central bank is buying it. So that's pretty much without question going to happen. So the bond play really is the safe investment for the foreseeable future. Okay, but healthcare, medical devices, are they getting a lot of buy orders right now? Sure. But we got to just look at the big picture. We can see these products are highly correlated to the S&P 500. The S&P 500 is trading as though we're in a perfect world where everything is going to run smoothly without any problems in the future, that every company in the S&P 500 is going to have plenty of profit and revenue growth for the foreseeable future. Okay, but that's just really not the case. In fact, we know for sure a huge percentage of the S&P 500 is going to be kept on life support at best or go bankrupt. We know almost every company under the sun outside of Walmart and Amazon is not hiring, they're firing. We know that most people are going to be, in fact, 75% of Americans have had a 25% income cut. So the amount of money that Americans are going to have to spend is reduced. The amount of money that corporations are going to make is thus reduced. So no, I don't think now is the time. I believe all of these go down until sometime around August, September, and that will be peak panic. That will be when we've had lots of earnings and profits downgraded, lots of unemployment, lots of pain. That's when we want to be getting into stocks. So we need a complete repricing of the S&P 500 to jump into that. Now, also, the debt hasn't even begun to be sold. So they've really sold a tiny fraction of that $2.2 trillion. And I believe it's going to get substantially larger than 2.2 trillion. So we can follow the money. The first step in following the money is realizing that it's all going to go to the US Treasuries, and it's all going to be bought by JP Morgan, one of the most highly profitable organizations in the course of history. Okay, they're the primary buyer of the debt. So step one, follow the money. Everybody's going to buy treasuries. Step two, where's that money then going to flow? It's going to flow into a lot of places, some of which will be kept on life support, some of which are going to see revenue and profits growth from that period, which I believe will be your set of ETFs. So again, to reiterate, I don't intend to buy stocks until probably around August or September is a good entry point. Now, I do believe that we'll be forced to get back to work because the gravity of staying locked down any longer will not be tenable for how much debt we have to sell, and that we'll see the virus, unfortunately, start to regrow into 2021. And so that's why I do think we're going to have a second massive wave that forces us into a new lockdown into 2021. And we really need a vaccine to cure this. So as much as I hate to see Bill Gates apparently trying to force the world into his vaccine, it does appear to be the only real solution. Okay, Pat says, how do I, as an investigator and researchers, help add to the portfolio research? Oh, sure. Yeah, I can definitely give you specific things to look for, Pat, that I could use help on. And that's excellent. Here's one thing that I'm really interested in, Pat, that could potentially change our timelines a little bit. And great question. So I think you'll find it quite alarming that it's almost impossible to find out in any area what the death rate is in the short term. So we found that, let me try to phrase this in a more clear mechanism. So what have we seen? First of all, we've seen both the US government and the Chinese government underreport what was really happening and tell everybody not to worry about it, when clearly, with a little bit of research, you could tell this was quite a large scale problem. That's one. Two, they've somehow fumbled the testing. They've delayed the testing almost as if they wanted to create a panic. Testing seems to be, to a degree, better now, but not everyone can get tested that wants to be tested. Okay, so that's another goof we've seen that we've predicted. So we've been able to predict this. Next thing we were predicting is that the lockdowns would be much longer than they're telling us. So far, that's played out to be the case. Okay, so what are some other things, some discrepancies I'm picking up on? Well, the next thing that I'm concerned about is they're not giving us a test to see if we've already had it, the antibody test. Now, is that because we don't have an accurate test, or because they don't want the population to know if they are good to work or not? So the antibody test is something I think a large amount of attention could be spent on, Pat. And so how would I change my forecast? Well, if I thought that this virus had been spreading for much longer than we've been told, and that a much larger percentage of the population already had it and was immune, well, then that really changes our timeline. And in fact, I've, with recent research, begun to believe that potentially 5 to 10% of the US population already has antibodies and doesn't even know it. So we're actually getting one report in Germany where they took a random sampling of 1,000 people who were asymptomatic. 1% had the antigen, that's the virus, and 15% had the antibody. Very interesting. So that still wouldn't really change our timelines for the stock market, I'm afraid, but it would definitely change our overall understanding of what's going on. So I began to wonder, well, let's look at Albuquerque, where I live. 500,000 people, currently about 1,000 active cases. So just about 2% of the population currently has an active case. So, but what about who's already had it? What about all the deaths that could have occurred for the last 6 months that were not tested for COVID-19? Well, what you'll find is that the states keep this data secret. They release a very generic report delayed a year. And so you really can't get an accurate count as to whether the daily death count has actually increased in the short term versus a year or so ago. So one thing I'm starting to wonder is, has this been spreading throughout the population for much longer than people anticipate? And do we already have a greater level of herd immunity than what's reported? So there's very little data out. And if there's one thing I would focus on, Pat, it would be trying to determine whether this is spread for much longer than we believe, which could indicate that this is less of a danger. And if that's the case, you got to ask yourself, why is that being covered up? So that's one topic that you could look at. In New York, I have some data from one researcher I follow that I'll put up on the screen. So I always try to play the devil's advocate to my own trading plan, obviously. And so really the only thing that could change this timeline, and I don't think it will change our short-term timeline, is this fact right here, would be the small test in Germany, which was only 1,000 people. But look at this, Okay, this fellow, if he has any bias, it's really just wanting attention. He's not selling anything. His background's in nursing. He's been doing a daily video. It's been extremely useful. But from April 1st to the 5th, there were 1,100 people found dead on the street or at home, 8 times that number last year. So that goes back to this. Okay, so I do believe they're not counting a great deal of the deaths, but this will be the most likely to be tracked and accounted, at least if you have any money whatsoever. Your family's going to demand that, and that will show up here. So that's one. But two, has this been spreading for longer than we've been told? And do a greater number of us already have the antibodies? And if so, why is this being held back? Are they trying to create a panic? Are they trying to create a collapse? You just have to ask yourself that. So I'm starting to collect data that would indicate that this has been spreading for a lot longer than we believe, which to some degree is good news. Now, not in the short term, but in the long term, because I was believing that perhaps only 1% of the population had been exposed to this. So still way too early, but if you had one area to focus on, Pat, that's what I would try to get to the bottom of anything regarding that. Okay, we got more questions. Let's see. Okay. Okay, Jim Wills, U.S. Naval Academy in Annapolis historically has graduation into May. They have canceled it already. Yeah, so school's out for the rest of the year. It'll be interesting if they try to reopen school next year.
Jason, this is Mark. I have a question.
Hey, Mark, how's it going?
Good. So you're talking about the death count as a leading indicator, but actually prior to that is hospital admissions. And I don't know if there's good statistics on hospital admissions, but you know the life of, or the life cycle of it is, you know, there's going to be positive cases, but like you say, that's not real consistent the way that's being done. But hospital admissions, you know, people get sick, they're going to go to the hospital, and then they're going to die. You know, most people that are dying from this are dying in the hospital, not all, because you know there's a lot of home deaths that are on the rise as well. But
so yeah, the death count's a lagging indicator in terms of the cycle, for sure. But probably about a 3 to 6 week delay from when people first get it. But I do think it's the only accurate figure that's actually being tested. So yeah, I agree with you in that it is a lagging indicator from hospital inflows. But I've got examples. For example, in New York, there's a fellow whose wife is a doctor, and they've isolated themselves. But the husband, who's not a doctor, doesn't work in hospital systems, he still can't even go get tested. They won't test him. They've told him just to stay at home. So the reason why I like this one is that I do believe it's the most accurate. But yeah, if we had a good stat for admissions and they were testing those quickly, then that could be a little bit, give us an extra week or two in terms of that. But what I'm looking for is for this to flatline for 30 days to believe that we've taken the right precautions to reset the clock. Okay, I have a comment from Gloria. I have read that the actual mortality rate is 2/3 based on the Lancet. So Gloria, in fact, if you think about it, someone who passes away is actually not a burden on the economy. It's really the people who need the ventilators and the specialized treatment, which of the people who go get tested, which is obviously the people who are feeling quite bad to be motivated to do that, of that group, 20% are needing specialized attention. So that simple fact is what's going to disrupt our economy, our medical system, and really the case for the lockdown is that we just can't handle all the cases coming through. Okay, so I've also heard if the patients get the malaria drug treatment, especially early on, it's extremely effective. Don't you think the possibility exists that if the drug can be made widely available, doctors treat before needing to be hospitalized, high-risk people continue to shelter at home? We could return to a rather quickly more normal. Well, so yeah, if we really wanted to use some sort of drug, well, first of all, how are you going to stop the kids who don't get sick whatsoever from spreading it? You can't. Okay, so that's part one. So if the kids are out and about mingling, this will spread. So unless you believe, so that right there really stops any hope for slowing the spread. So the spread's going to continue. Now, can we reduce the mortality rate and maybe reduce the time spent in ICU, potentially with some of these drugs? Maybe, but they have to be picked up super, super early on. Right now, the way the medical system is dealing with this is that they're so overwhelmed. They're saying, don't go get tested unless you feel like you're about to die. And unless you feel like you're about to die, we're not going to take you into the hospital. So we're nowhere near that capacity. But yeah, I do believe we, in the coming months, will have extreme testing at a very, you're going to have to wear some sort of identification as to whether or not you have the antibodies. Now, unfortunately, we're also, so the best case news I have for us is that this has been spreading much longer than we thought. It's less dangerous than we thought because a lot higher percentage of the population's already had it. But the bad news is that we continue to get cases from South Korea, over 100 now, where people were diagnosed as cured and now are reinfected, which is very, very troublesome. So what I believe will happen is a global shutdown into June that's much stricter than we're in currently, and that we're going to reemerge with extreme testing, some sort of identification as to whether you've had antibodies and are presumably safe, or whether you're currently, there'll be really three statuses. Either you're infected, haven't been infected, or cured. And that'll determine what you have access to in terms of being able to go to stores, work, things of that nature, school. And then we need a vaccine. Now, again, if it's, I have a hard time believing it's really widespread because there's been so few deaths here in Albuquerque. But again, if they just were simply throwing people into body bags and calling it something else for the last 3 months, that could have been hidden at least until recently. So I would have suspected that there'd be more deaths in a random city like Albuquerque if it had been widespread. So I do believe that, unfortunately, we're still, in terms of, think of this as a download. We're trying to download the virus into the population, create herd immunity. At the best case scenario, I think we're maybe as much as 5% complete out of 100% download before we'd really have some sort of herd immunity. So do we go on and off of lockdowns to reduce death and at the cost of the economy? Or do we let it rip through society and have a better economy? So I think that's a tough decision for governments. I know the businesses want to let it rip through society and get this going because they don't want to stop printing money. But on the other hand, if you have primarily your voting populace dying left and right, then if you're looked at as having dealt with this crisis improperly, then good luck being voted in the next term. So if you do assume that a president's motivated to be reelected, that deaths will be more important than jobs or stocks, at least, then I would anticipate that we have on and off lockdowns until there's a real solution, and that we'll have free money to keep people living. And this will come at the cost of valuations in stocks, real estate. Julio, what affects the movement in the Yang? Good question. So Yang is inverse of FXI, which is your large cap Chinese companies. Dan O'Connell says, did you say it is still early for gold? So let's look at our gold chart. Okay, so I love to look at correlations. A lot of big money trades correlated. Let's go back to the last crisis for a little feel for gold market. Okay, so 2008, purple is your stock market. Stocks crashed. Gold miners crashed. Okay, so colors, let's just do colors first. Purple is SPY. Silver, spot silver is yellow. Gold miners is orange. And spot gold is the candlestick, green and red. So stocks crashed. Gold had an early rally, but then crashed. You can see the overall move was flat from where the stock market topped out to where it bottomed out. Gold had a little bit of rally, but it did have some downward movement. So go back to the margin call. Margin calls cause people to sell everything. Okay, so gold did a relatively good job during this period, and that's spot gold. Okay, but let's look at catalysts. Well, when did we actually do QE? Right here. So it was November of 2008 when they came in and said, we're going to throw $1 trillion a year into quantitative easing. So again, that's the cue for the primary dealers to sell the bonds that they bought a year early. So the Fed predicts all these crises way before they happen. They're very good at that. And they know how to, the problem has to be resolved at the government level. So big banks loan the money to the government, and then the government pays them handsomely. Once they pay them handsomely, that's when we do QE. That's what QE is, paying banks for loaning money to the government. And then what do the banks do? They get to buy stocks half off, and you get these huge rallies. So the only reason I wanted to get into gold early was because we've been doing QE earlier than normal. Now, I do believe they're going to reduce QE every week, which they have been doing. So they've been going from 65 billion a day to 50 billion a day. I believe this week it's 25 billion a day. So they've stabilized the markets enough to create this buy and hold carrot for the bond market. So that's the real risk, is that there's a huge correlation to stocks and gold. And so that's the risk. But the difference between 2008 and this current environment is that we have at least done some QE early before we've done rate cuts, wait a year, solve the problem, then do QE. This time we're doing rate cuts and some QE. Now it does look like they're going to tide off the QE. So that's one. Two, I do want to point out that gold miners bottomed out and rebounded way before the stock market did, and went on to be a top performer for quite some time. And it was only after we'd done QE for a better part of a year and a half that spot silver popped up and outperformed. So in our portfolio, let's zoom in on this. So we can see that just dead obvious correlation right there. So my only concern here, Dan, is that fundamentals for gold look really good. Cheap oil, we're definitely expanding the money supply, but really gold's supposed to be an inflationary play. You got to ask yourself, do we have inflation when there's perhaps 30% of all demand being cut from unemployment and decreased earnings? So I think we're going to have a inflationary shock. That's going to be very good for the bond market. So it's not the same as 2008. So we can't play it exactly the same. We have the married put. So we've bought our 12% stake in GDX. We're starting the timer so that we have that year hold. And in a year from now, I'll probably be starting to take a little exposure out of GDX and getting into spot silver. So we do want to start the clock early as possible so we can get the lower tax rate. So we hold for a year, you get much better tax. And again, I believe we could see gold miners crash with the stock market, but it won't matter because you have the 23 put and the 28 put. So my plan is to hold the position and sell those puts for a profit and then to let it rebound back up. So we have downside protection. If we're wrong, stocks crash and gold miners go up, then it's fine because we're long the asset. We just pay off our puts. If gold miners go down with stocks, then we're fine because we have that in the money put. We're going to sell those for a profit and then remain long our gold miners. In terms of wanting to play spot gold, I do want to try to play that on the next big sell-off. And again, all it takes for a sell-off is the big banks do a timed sell that they know is bigger than the current bid, and you can get some sharp moves in gold easy. Plus, they're always shorting it. So I think we'll have a better opportunity to play the GLD product. So that's, if stocks go up, then I guarantee you gold miners goes up with it. So that's really your three outcomes. Hermant says medical device companies have slowed down as non-essential surgeries are postponed. Will there be a pent-up demand post-July? Yeah, so I believe the next 2 years are going to be a growth period for healthcare, biotech, medical devices because of this pandemic. So if we believe, big picture is we really have two options to fight this. Okay, if there's 7 billion people, and it's going to, let's say, affect 10% with the stats we have, that's 700 million people. So I'd suspect that no less than 7 million people die from this. And that would be if we have extreme lockdowns until a vaccine comes out. Okay, so that would be like the best case. And so if we look at this, the cost to the medical system is not anywhere near complete. So there's just not enough of this has been put through the medical system. So yeah, I believe we're just really at the starting point for the increase in money flows to those sectors. And in general, those sectors have outperformed the S&P 500 also, but I believe that it'll be dramatically more in need in the coming months. Okay, Bill Richardson, eventually there will be a need for an alternative currency to the US dollar. What preparations can we make for that eventuality? When should we start making these preparations? Yeah, so really, Europe's worse shape than we are. So Euro's one product that tried to compete with the dollar. Let's pull up our currency tab. Okay, here's the main competitors. Now, interesting enough, the Chinese yuan just got added to the IMF's basket of currencies, which they don't have an open economy at all. So currently, every currency is really weakening against the dollar, as we can see here. And so my anticipation is we're going to expand the bond bubble until we've paid off this this debt to absorb the losses bill. And then we're going to have to hike rates. And that's going to really crash stocks, bonds, protect the dollar, and really cripple our enemies. So I do believe the dollar is going to continue to be the strongest. Now, you know, the Japanese economy is really terrible. So some people are playing the yen as a safe haven, but when you look at their fundamentals, there's really not a healthy balance sheet out there. Russia has a healthy balance sheet. Probably Russia has one of the most healthy balance sheets out there as a country. But guess what happens when the U.S. goes and wreaks havoc on China? So I'll keep a close eye for alternatives. Really, I think there'll be a period of time where gold does that job for us, Bill, as a another rumors that they're going to create a brand new world currency and use that to provide free money to the world as we go through this pain. But yeah, I don't see the yen really having any advantage. The euro, Europe's on the verge of bankruptcy. Chinese currency is extremely overvalued. You just can't trust anything about China's numbers at all. So it's really not a good option currently. So I do think, you know, follow the money. First, the money goes to the U.S. government. U.S. government's going to reallocate that to everyone who's in trouble or where we need the money, which will probably be mostly in the medical space and for keeping people with some food in their belly when they have no jobs. From there, that could slowly create inflationary pressures once we get everybody fully employed. So it's going to be hard to have inflationary pressures until we have everybody working. So if we have a third of the population unemployed, very low risk of inflation. So I think short term, the dollar is going to rise and not lose value. And that will coincide with a strong bond market. And I do believe, again, our best weapon will be to weaponize the dollar. So we're going to go dilute all our debts, printing money. So that's great for the United States. Sucks for everybody holding dollar debts. And huge advantage to being the reserve currency. So no other country can bail themselves out like we have. So that's step one. Step two, we're going to get all these people back to work slowly but surely. As we do that, then we can start to see those inflationary pressures. We need to get oil back up to 50. And then that's when I think we're going to go heavy on gold. And at that point, it'll be hard for central banks to control it. I think that's a year to 2 years out before we see the big gold rally. So again, to really sink this in, the 2008 crash, let's look at that crash. This is important. It's a lot to ask you guys to sit here on these puts when the market just does nothing or goes against us. So let's just look at the 2008 crash. Just want you to see how quickly it happened and how few trading days there were to catch it. Okay, so here's our 2008 crash. Oops, that's China, sorry. Okay, so here's 2008 crash. All of a sudden, people are digging into all these derivatives, selling these different mortgage products. And then they're going into the actual books and they're realizing, wow, about 25% of these people aren't paying their mortgage for 3, 6, 9 months. That's not good. And so slowly but surely. But really, the bulk of this decline was really captured in a few trading weeks. In fact, the majority of it was right here in 2 weeks. So a huge chunk of this move. So it took to just get from the 0% level to down 16%, took from November of 2007 to September of 2008. But then to get from negative 16 to nearly the bottom occurred in just 2 short months. So this whole drop could be achieved, and most of that was really just in 2 weeks. So then it kind of flatlined, you got one little less move. So our entire down move that can put our put options into the profit zone could occur in a handful of trading days. And if you look at the details of this period on a daily basis, it's really about 3 trading days dealt most of the losses in the S&P 500. So this is a position you want to put on and sit back on and not try to time, because if you try to time it, you're going to miss it. Ross says hi. Jason, hi, Ross. Do you hold most of the SPY or TLT to expirations? The puts and the calls, Ross. So the puts will be trying to sell once they're in the money, or when we think there's a bottom in. So probably around August to September, I'm going to sell. Let's look at the puts we have. These 3 I intend to sell this year. These 2 I intend to sell next year, just to simplify that. These we're holding, if they're in the money, we'll hold closer to expiration. And if we also see a big jump, we're going to take some profits early. Now, I had people hold this when we're at 180, and it was a huge mistake. We should have taken some massive profits off the table. But what happened was we had margin calls at a central bank level. So we literally had the biggest banks in the world, not primary dealers, not hedge funds. We had central banks having to sell their treasuries. Otherwise, their whole financial system was going to collapse. So these we will time a little bit differently. Okay, going through. We got more questions, just getting through all these little messages from Dean. Okay, Gloria, please don't hate me, but the stats as of yesterday, I just read Albuquerque is 440 cases with the population. Puts the infected rate at 1 out of 1,000. Gloria says, seems like a overreaction. How about a little personal responsibility instead of government mandates? Well, yeah, so the problem, Gloria, is that this has been growing exponentially. And there's really nothing, you can't really have personal responsibility with something that's invisible. So they're going into ICU locations now. This is an interesting study, but they went into an ICU and they started swabbing the floor, the soles of shoes, handlebars, and they found 100% contamination. So the virus is living on surfaces that you just can't see. So that's one. Then they went to the pharmacy that only the doctors go to, which are in a completely different building. And so the infected people can't go in the pharmacy. With a 50% accuracy, they found the virus in the pharmacy. So it's really absolutely impossible to stop the spread. So yeah, you really boil this down to 2 questions, Gloria. Do we want to kill the economy and save lives? That's one option. which I believe the politicians will have to make. The politicians want to get the vote, but they want to keep their donors happy. Donors are the big corporations, voters are the people, right? So we know that there's pressure on both sides for the politician, but at the end of the day, they have to get the vote. So if they open back up the economy, my anticipation is that this would start to grow back at this rate. Remember, this is 100, 100, 10, 100, 1,000, 10,000, 100,000, a million. So this is log scale. So without question, this is absolutely deadly, one. But the deadliness isn't the problem. It's the people who lose oxygen, whether it's from their lungs becoming infected or perhaps something at the blood cell level. Something's causing people to not be able to breathe. And it, from the cases that have been tested, which I believe is diluted, to be fair, that's 20% are needing oxygen and ventilation and expert help at a hospital. So that's really the problem. And yeah, you could open it back up and that would save the economy, but you're quickly going to see deaths and hospital systems get overran. And that's really very hard to dispute, I'm afraid. But you're going to crush your economy. So they're going to have to go back and forth. So no matter how you dice it, debt levels are going to grow, bullish for bonds, and profits and earnings are going to decline, bearish for stocks. Really simplifies life if you just boil it down to those two facts. Inflationary pressures will likely be muted until we get the full workforce back. So that's really your best catalyst for gold. Now, people like to just play that gold's safe haven, that it stores value, and that we're devaluing the currency. But I think it's going to take some time for that to turn into inflationary pressures. Florian says, how's gold fitting into the big picture? Oil cuts are causing a move up for oil, but are the cuts big enough to justify it? So yeah, we're going to have every storage facility full to the brim in a few months in the oil market. So I do think oil will go lower. John S. says, Gloria, could the low infection rate be due to social distancing in place? Yeah, well, absolutely. So social distancing works, but we know what it does. It kills your economy. So it's one or the other. Do you want to save lives and keep the medical system intact at the cost of your economy? Or do you want to keep making money, but you're going to get a bunch of people sick? So there's no real solution to that. Okay, Pat said, oh, go ahead, Dean.
Oh, I was just going to say, Sue L and Ross have their hands raised too.
Okay, great. Let me catch up with all the chat box questions and then I'll look at Mike's. Yeah, I still see 30 messages below. Pat says, did you see the Ray Dalio TED Talks? I sure did. He literally says verbally out loud that we are in a depression. Yeah, I did. I did see that. It was good. It was a good one. And that will be one of the videos for boot campers tomorrow. So thanks for pointing that out, Pat. And I did watch that. Interesting, the lineup that TED Talks brings out. Bill Clinton, Ray Dalio, Bill Gates. Gloria, agree, but my belief is we need a better plan. Disease is serious, but not deadly for most. Keeping people out of work is going to have devastating consequences for a long time. If this continues, let alone businesses are recovering. The cure, in my opinion, is worse than the disease. Well, I would agree to some point. Now, opinions don't really matter. What I'm trying to do is predict what's going to really happen and how to play that in the market. So I could agree with you all day, but that doesn't mean we're going to change our trading plan. What I believe will happen is that politicians will, because of death count and overwhelming hospital overflow, are going to have to be in a on and off button for locking down the economy, and that this will be a drag on profits and earnings. So if you really look at it, how do we keep the bean counters happy and win the election? Well, we tell the bean counters, look, if we do a lockdown till June, we can really restart the clock and get us through election and get everybody back to work going into summer. And by then we can get everybody masked, we can get tests all over the place, and we'll be able to pick up new cases quickly and jump on it and then go trace whoever they've been in contact with and try to just do many lockdowns. Okay, so I think that's what will work, and will keep the bean counters happy, plus get the president reelected. If he really reopens this in May, I think it'll be a disaster. If they reopen in May, I'll be very inclined to get more aggressive at betting on a bigger stock crash. I think the smallest stock crash will occur if they lock down today through June and then reopen with extreme testing, the digital certificates, testing ever. You're not gonna be able to go anywhere without some sort of identification that you've been tested. So I think that's what keeps the bean counters happy. You open this back up in May and it's a recipe for disaster. So I highly, highly doubt that happens. Hemant says how to boost your immunity. Yeah, so I do a lot of things to boost my immunity and follow that sort of stuff, but I don't think that's necessarily gonna work when you got people who are, what's the leading cause of death in America? Number one cause is heart attacks. So if that wasn't scaring them to have a healthy diet, I don't think diet change is going to occur anytime soon. So top two deaths in America are heart attacks and cancer. So we're definitely at a high risk of immune risk to this. Jack Tan says there's 2 puts. Are we supposed to take both? Jack, you should only have the 28 right now, not the 23, because you got into that position much later. Everybody has that 23. I'm telling them to hold because I think we're going to be able to sell both our puts for a profit. So I didn't want to sell the 23 at a bad time. Gloria says, totally agree with you. 80 plus individuals are majority of deaths. They need to stay home, period. This alone would help greatly. Yeah, I don't know. There's people of all ages dying from this too. So, okay, great. Let's look at hands raised now, Ryan. I'll pull up our option page 2. Before we do the open, let's review our options for everybody who's interested in joining the program real quick. Yeah, did you want to go through the breakdown in our 4 products, Dean? I'll be right back. Still there, Dean?
Jason, yeah, sorry, I was on another screen and had to unmute.
Okay, I'll be right back in 2 minutes while you cover this.
Okay, cool. Okay, guys, so real quick, you're going to see a couple options on your screen, okay, as far as how we can help you. Number one, kind of really sidestep this stock market crash, okay. Number 2, show you how to build your wealth in this scenario instead of donating your wealth. Okay, and then really take the capital that you've built and expand it, and then go in to buy the market at much lower prices today. Okay, so the first thing you're going to see is the buy and hold portfolio. People that have less than 30,000 are using that portfolio. Just trades ETFs, super simple, very the least amount of work possible. Okay, and people that have less than 30K are using that. Okay, now the basic option portfolio, great for people between $30,000 and $75,000 to invest. Okay, because you will get options leverage, which is phenomenal. And if you have between $30,000 and $75,000, you don't have options yet, we'll certainly help you with that process. It's really easy, actually. And it's really neat because you'll have an expert designing your trades. All you have to do is replicate them. And currently, that's portfolio is structured with our S&P 500 puts. Okay, so great way to utilize those put options to then grow your accounts much, much larger and then go buy it once the blood has flooded the streets, but we're not close to that point yet. So we want to be short the market until that point. Okay. That will run you just shy of $2,000 a year. The pro portfolio is what, really all of our customers that have $75,000 or much more, the typical person that's using our pro portfolio has at least $200,000 in the market, and many have excess of $2 million following this program as well. Okay. It's going to include the basic portfolio, okay, but it also has exposure to, so we're currently short EEM, okay, GDX we're long, as I'm sure you could understand from listening to the presentation, and we're long TLT, okay, and then we used to own the S&P 500, and this asset class, guys, and really both the pro and the buy and hold, you're just going to own 3 asset classes, guys. And the pro portfolio is going to show you when to be long or short those 3 asset classes. Okay, a lot of people don't know, guys, that you can literally own the proper ratio of bonds, metals, okay, and stocks over the existence of the U.S. equity market. And as long as you have the right ratio, you actually historically make 9% a year without doing anything but just owning the right ratios. Now, if you're sophisticated enough to understand when to be long or short, the only 3 asset classes that truly matter, okay, then you can get some more alpha out of that type of positioning, okay? And so that's what the pro portfolio is going to do for you, okay? It's going to give you the most access to us as far as any of the portfolios, okay? And like I said, you have to have at least 75,000 to do that, but is certainly utilized with people, $500,000, couple $1 million in their trading accounts, and just phenomenal. Our intra-month drawdown low was 1% on the pro portfolio, and that's really its biggest attraction to investors, right? So people that have a lot of money don't want to lose it, okay? So they love the pro portfolio, okay? And there you go. Jason's back there. And the other thing that we have as well is the Bootcamp, and that's going to teach you how to literally think like Jason, how to understand how the market can why, and how you want to structure your trading in those scenarios. So kind of, the different levels of service, obviously higher level of service, the higher the purchase value is. Okay. But really cool too, guys. If you do make a purchase to any of these portfolios, while we have the spots available, and that does fluctuate, right? Because we give away 30-day trials. But right now we do have spots available. So if you buy any of the portfolios, you'll actually get access to the Bootcamp for 30 days at no cost. So phenomenal to ramp up your education, okay, with our help. And there's also a couple bonus trades in the Bootcamp that you'll learn about as well. But yeah, that's pretty much it. Anything you'd add to that, Jason?
Oh, that's very, very good.
Cool.
Let's go ahead and do some questions now. I see Sue has her hand raised.
I'm not sure. I can't unmute her.
Oh, okay. And she may have got her questions answered earlier. Yeah, if anybody wants to chat, please raise your hand. We'll unmute your mic.
Yeah, and jump in, guys. How many people will text me, after the webinar with a question they could have had addressed live? Just want to encourage you guys. That's why we take the time, right? Jump in there, ask that question. Don't hold it back. We'd love to help you.
Carmen, please. Let's see, you have your hand raised, but your mic is muted. You'll have to find your little unmute button.
Okay, thank you. I
There you
found you on YouTube, and I thought that it was very interesting what you had to say. First of all, I wanted to know, how long have you guys been around? I've never heard of you. And I've been listening to your webinar, extremely, extremely interesting and intelligent. I said, here's some intelligent guys say something intelligent. I've never heard this stuff about the market or the way you guys are trading. So anyway, I'm just interested in knowing more about you.
Sure. Well, let me give you a brief overview, Carmen. This particular business has been operating since December of 2018. And so, yeah, that was a challenge, jump out there and try to sell an advisory where you have a 1 month track record, right? So what was my background and Dean's background? We started a company called Market Authority back in 2008. And essentially, prior to that, my background was actually taking very profitable businesses, online businesses, and helping tweak them to be more profitable. We made quite a name for our company doing that. And then all the big finance guys came in and started wanting us to optimize their businesses. And so in 2008, I knew nothing about Goldman Sachs, the stock market, or anything of that nature, but I sure did understand how to optimize a website. And so that's when I first started taking on clients in finance, and eventually realized I loved it. And so stopped optimizing other people's businesses, started building my own. And since 2008, I had gone and hired every Joe Schmo under the sun, from Timothy Sykes to Chuck Hughes to Matt Hedge Fund Trader to different folks from Agora, just everybody you could possibly imagine. I was the guy creating a contract with them, understanding what they like to do to trade with, going out and marketing their products and services, and then realizing that most people who bought their products weren't getting the results they were advertising. So for the last decade, I've sold tens of millions of dollars worth of every other guru out there. And you'd think after all these successful track records, I would have been able to go and actually Dean was in charge of this back then. As I told Dean, hey, let's go collect testimonials from all these happy customers. Wait, how come no one's coming back with testimonials? Oh, wait, no one's getting the same result. So for the last decade, we sold literally tens of millions of dollars of just about every guru you can think of product. And I found there's a big disconnect. So my background was understanding what they did, what their strategy was, doing quality control over their tradings, and then starting to slowly but surely realize that nobody was getting the same result. And so then the big question was why? So long story short, after getting fed up with everybody else's products, I began to dabble in my own. And I've had different products over the years. This is what I believe is not necessarily what everybody wants. Everybody wants 100% return, instant gratification, big promises, risky trades. Nope, what everybody needs is a nice, easy, safe 1% a month. So after over a decade of doing this, I decided let's put out a product that not necessarily what is the shiniest, not necessarily what everybody thinks they want. Let's create a product that they actually need, that works, that's not risky, that's good for people going into retirement to safely build wealth. So that's what this product is. We've been proudly presenting it in this format since December. And we've gone from a crowd of a couple people. I never forget, just last year, in fact, my boot camp was just me and Donald Dickey every Thursday. Now we've got 40 plus people in our boot camp every week. So we've slowly grown it. We've published everything. And what's the big difference with what we're doing compared to what everyone else does? So there's a few things I discovered that would really help people get the real result. Number one was throw out all the risky strategies. Okay. Everything I've seen is so risky. So risky. That's what makes things shiny and attractive and have these outlandish promises, is they're going to go invest in risky stuff. So we threw that out. Next thing I found was that people aren't getting the same results. Even when the trade did work, people weren't getting the same result because they weren't entering the trade at the same time. So the next thing was, all right, we got to restrict when we place trade alerts. We have to have a system that is easy to follow. Okay, so the next step was, all right, we're going to only trade at noon Eastern on designated days. That way, when I place the trade, you place the trade. Okay, so whether we're winning or losing, I can promise you we're getting the same general result because we're all placing the trades at the same time. And guess what? Every time there's a new trade, you have access to me for a couple hours. So there's no confusion. There's no excuse for being confused. Okay, what was another big problem I found? Well, I'm going to shout out. So with people like Timothy Sykes, Jason Bond, that's your classic, okay, they're going to buy a small cap stock. Then they're going to go alert it to 1 million people. And that 1 million people is going to drive up the price. And then tomorrow they're going to go sell it. They make a profit, front running their clients. And then by the time you get the sell alert, it's already crashing. So you bought it at a higher price, you're going to sell it lower price. Okay, so we fix that by dumping illiquid assets and only trading the biggest markets in the world. So the biggest markets in the world are bar none, the US government debt market, and then the S&P 500. Okay, now I'm taking a little bit of a change in our standard protocol coming this summer by realizing that most S&P 500 is going to be on life support. It's not going to be thriving. There's going to be very few sectors that are going to have revenue growth, profit growth. And I believe these are the sectors that are going to do well because they're going to be the direct beneficiary from the government. Okay, so we remove the risk of having bad results of the guru versus the client by two main things. One, we do the trade at the same time every day, so everybody gets at the exact same time, and they can anticipate that. So like religion, like getting your newspaper in the old days, right at 5 a.m., everybody loves to join our webinar. Even though we haven't changed our trades for like a month, our hardcore crew still shows up just to come here and hang out and chat. Okay, so that was a big fix. Get rid of speculative crap, do the trades at the same time. Okay, so some people, all you guys have heard about that are bad at this, Timothy Sykes, Jason Bonds, they're absolutely horrible. Okay, they do illiquid investments, they front run their own clients, and it's unpredictable when you'll get a trade. That's not going to happen here. Super liquid, predictable times. Okay, next big problem is that most investors don't, like Chuck Hughes, probably a notable one that's guilty of this. Now, mad hedge fund trader, John Thomas, I don't know if you guys heard of him. He's another guy. You're never going to get the price he quotes. Ever, ever, ever. Okay, so that's not a problem with ours. Okay, the next big problem people do is Chuck Hughes, for example, but a lot of them, Angel Invest, a lot of these companies, they don't have a position size. They say that's up to the client to figure out how much of their money to risk in each trade. Well, what's the problem with that? Well, I can tell you what, Chuck Hughes, all this crap about winning all these options trading competitions who, by the way, were forcing him to remove the logo off his website. I'm trying to get his broker statements to audit when I'm selling his products. You know, he sends me over buckets of crap. You can't get through any of it. So I started looking at his track record. I realized here's his catch. He doesn't have a limit to his account size. So he'll sit there and follow the 250-day moving average, fling out trades, play the momentum, play the trend, play the trend, play the trend. And then the trend breaks. A fundamental crisis happens. But for Chuck, it's not a problem because now he's just going to triple, quadruple down in the opposite direction. So while you had 100% of your capital playing a bullish move and you're now down 90%, he's pretending like he's only used a small percentage of his portfolio, and now he's got plenty of cash on the sidelines to reduce those losses by playing a new trend. So if you don't have real position sizes and a real model portfolio, then people are going to blow out their accounts. I'm sure a lot of you have experienced that. So in our program, every penny is accounted for. with great accuracy and with great organization skills. And in fact, this spreadsheet right here is what you'll get when you join our program. And I'm going to make you fill it out so that you keep track of every little penny following our program. So we have it organized with US equities, the bond market. So you get a real hedge fund level accounting system to put to work with a system that's super easy to follow. Very few positions, highly liquid. So I guess that's really a good breakdown of what's different between us and other people. My background was managing everybody under the sun for the last decade. At the same time, I was starting to see what's working, what's not working. Got to learn a lot from these fellows. And I study a lot, Carmen. I really study a lot.
Yeah, and Jason, I would just kind of echo those statements by saying, guys, we had the ability to see what worked, and there wasn't so much of that, but also what didn't work for literally tens of thousands of clients. And so it was really nice for us to see all the problems, create the solutions, and deliver a higher level of customer service and interaction. And it was the lack of interaction was just huge. And liquidity, oh God, I can't remember.
Oh, and we got rid of, so here's what I also came to learn from a decade in the business. The refund rate was a good measurement for how happy people are, right? Our product has a 0% refund rate, which is fantastic. In the last decade of doing this, it was over 50% if you had a decent product, and upwards of 60 to 70%. So you just knew it, just whatever they were doing just was not making people happy. Okay, also, you have to think about, how did they bring in clients? Well, most products, you go read some 30-foot sales letter promising you the sun. You pay the money up front, right? And then you have a refund period. And they just basically hope that you're going to forget you bought it. That's really what their whole business model revolves around. Promise the sun, deliver nothing, and hope they forgot they bought it because they're older. It's sick. Okay. And they thrive on 50% of the people forgetting they even bought it. So our product, no sales letter. We give it away. You're getting the full experience. You're getting the real trades. And that's why we have no refunds, because you know what you're getting into. Gary says, is there a threat? And does that, any other questions, Carmen?
Yes, another question is, so this Monday webinar, because it's taken up all my morning, I need to leave. Now I need to leave. But how long are these webinars that you have on Monday?
People like to chat with me as long as I'll let them, Carmen. So they can go 3 to 4 hours, but there's no need. Like I said, we haven't changed our positions for weeks, but our same crew likes to show up and hang out. So we have something of a community with our.
And one more question: what is the minimum portfolio amount, or what is a suggestion for if I was to decide to join your service? What is the minimum portfolio?
Well, I would tell you, if you have 75,000, and you really okay. Well,
no.
Do you have 30,000?
No, I have like about maybe 10.
Okay, so then you should do the buy and hold. Buy and hold can be built in increments of $1,000, and it's super easy. And it has a nice return too. Its disadvantage is we're not going to be able to get leverage from the option market. Its advantage is it's super easy, it requires the least capital, and it has the least moves. So you build this and just sit back.
So you work in bonds, metals, and stocks. And in stocks, are they individual stocks, or are they the SPY, like everything?
Right. So we like to use highly liquid ETFs.
Okay.
And yes, we have a stock bond commodity strategy.
Okay. Well, I'll watch you guys for a week and then I'll decide.
Okay, great. Thanks for asking your question,
Yes,
Carmen.
thank you so much for the trial. Thank you. Very, very, you do a lot of research. Thank you very much.
Oh, my pleasure. I love it.
I will have 3 more webinars this week also, Carmen, and not just Monday.
Oh, okay. And what is the Bootcamp anyway?
Bootcamp, I'm going to teach you how it all works.
Oh, I see. Does that come when you sign up?
You get a 30-day free bonus into our boot camp.
Oh,
So you can go through all the modules, and it's kind of like joining Netflix. Go watch all the movies you love, and then you could cancel if you don't need it after that.
right. Yeah, this sounds like an MBA education.
No, we're gonna dumb it down and try to keep it simple. So right now there's a pretty simple calculus. Government's gonna blow out its deficit. What's new there, right? So we like bonds because of that. Growth in debt at the government level is good for bonds. And they manufacture that to be good for bonds because it's their own banks that are buying it. So that's really our most obvious play here. Usually you can't blow out your deficit and grow your private sector at the same time, because those two assets compete with one another.
I know that was fascinating to me. I've never heard this before. I got to get this in my head, of the way you explained the way the government buys the bonds and creates this mess and just makes the stocks go down. It's just insane. I'd never heard this before.
If we had it my way, we would reduce the government by 90% and we'd abolish the Fed. And everything I've told you wouldn't work. It would all be exactly the opposite. But instead, we grow the government at rapid pace, and we have a Fed that ensures the growth of the government debt. So
Wow.
they're in cahoots, and it's not just in America. The same bankers own every government from here to China. And so yeah, I really like the bond position in the current environment.
It's interesting what you're saying, because I heard that there was only 5 families in the whole world that owned all the currency in the whole world. That's what I've heard. Yeah. On the black market. Yeah. Interesting. Thank you.
And one of them's Bill Gates.
Yeah, Bill Gates and the Rockefellers. Yes, that's what I've heard.
There's certainly some powerful people out there. That's without question.
Yes. Thank you.
My pleasure. Let's see who else is out there wants to chat. Karen, you still out there? We got to get Karen's piece in. Or she have to take off? Gary says, is there a threat to technology failures moving forward? Yeah,
There always is.
Yeah, the tech sector does good in a healthy growth environment. So no matter how you cut it, if you have to lay off. Oh, Karen, how's it going?
Oh, it's going.
For everybody listening, Karen gets a guaranteed audio clip every webinar. She's our favorite.
Well, I'm sorry I've had so many interruptions this webinar. I've got to catch up later on. I've had two conversations, one who just had to put their cat down, I'm sorry to say. So
No.
I know, too much drama going on today. So I've missed a few of your things, but
well, nothing's changed on our end. So
I know I had an FXI question though. I'm not sure if you actually answered it or not. It was early.
Oh, go ahead.
It was about it was my concern that in typical fashion, even though I know you've got that FXI put, I started thinking about it and I said, yeah, but PBOC, they always tend to step in. I mean, who's catching up to whom? I'm starting to feel like the Fed's trying to catch up to the PBOC at this point. But if they keep propping it up.
Okay, so my expectation is that that's a good point. Let's pull up this chart. So China.
And not only that, but there's always a little pressure over there, and I don't want to say what I really want to say, but you know what I mean. But they won't even let them sell, even though they want to. So that's my concern.
Okay, so let's go over that. Good question. So
thank you.
Candlestick chart is the green and red. That's SP. That is emerging markets. So that's the bigger index that covers China, Hong Kong, South Korea, Taiwan, Russia, and India. So all your big emerging markets in one nice basket. Then we have the SPY, highly correlated to EEM, currently in purple. We have South Korea, an ally of the US, in turquoise. All these are just super tied together. And then you got China, who is full of shit. And their market's outperforming. They've dealt with the crisis better. They're blocking people from coming to China. They've outlawed selling their stocks. They've popped up their own stock market, and they're greatly outperforming. So Karen says, I'm worried China's just going to manipulate FXI. I agree. So why did we put a bet on FXI? Because of the decoupling of the United States and China. I'm expecting the US to place sanctions against China, which could involve restricting capital to FXI. So it's critical to understand what is FXI. So the underlying asset is held in either the Hong Kong Stock Exchange or the Shanghai Stock Exchange. Okay. So in the US market, we're not buying that. We're buying a product that has exposure to that, much more complex. So it's called an ADR. So we have essentially a piece of paper that says we have rights to something in a different market that's non-US. So while China could sit there and prop up the Shanghai stock valuations all day, what they can't do is control what the government does in terms of capital restrictions to the American access to these. So the Americans buy this exclusively through the US stock market, not the Hong Kong market, not the Shanghai market, through ADR ETF baskets. So all we have to do is say, China doesn't allow us to audit their companies. Therefore, that's against our Securities and Exchange law code, which it is. And then bam, they wipe it off the US stock exchange altogether. So even the threat of that, the threat of restricting capital flows to Chinese index products, or the bigger move, which would be to just delist it. That's why we want to be short FXI. It's because they're going to intervene. And that's my expectation, is that we will absolutely not let China get a leg up on the United States. So if you believe that China either created this mess on purpose, or it was created and they just simply took advantage of it, doesn't really matter. We can see already the politicians are starting to place the blame on China. They're going to say that China deliberately covered this up. They went and hoarded all of the medical supplies around the world while telling us it doesn't spread, which they did. And now we're going to retaliate. And that retaliation is going to be to restrict capital from flowing to China, and or simply delisting these ETFs that flow American retirement money unknowingly into China. So that's really the big picture, is the US Chinese decoupling, separation of economies. And if that happens, your FXI goes to zero, it's delisted, and you get the full value of the play. So that's a really good opportunity. Or if they don't go to that extent, these still are highly correlated, so it should still fall. So that's why I like shorting FXI.
Would you consider going out a little further just in case?
Further in duration?
Yes.
Well, yeah, but I expect, again, that we're going to have a big move into summer.
Mm-hmm.
So regardless, I want to sell this current put sometime around the same time we're going to buy stocks.
Okay. All right. I see.
So if they don't make the move leading into this election,
right,
then I think we'll have a second opportunity to place the same bet around December. Okay.
Because of course everything regarding this election is being deferred anyway, so I'm kind of looking at expirations going, I almost feel like, because I don't know. It's just a feeling, me, I get something. I go, wait a minute. Am I letting it? Logically, I understand. And then I think to myself, but there's nothing logical right now. So, and every time I turn around, there's another deferral because that's all and I think the only other point there, the only other option was like out to January. I didn't even look at it right this second, but it was something I was looking at over the weekend. I thought, because I hadn't put it on yet, and I went, because I missed it, and I went, I got to do this on Monday. And then I said, let me think about this and let me ask a question. So I understand what you're saying. And yeah, I mean, to me, it's great. If the thing just disappears off the face of the map, we get 100% of it. I'm all for it. Both is, for the portfolio and simply because.
So yeah, so you'll lose the
Great.
dollar and you'll pick up the 31.
Right. Yeah, that would be ideal, but we'll see.
Okay.
I love it, but we'll see. All right, good. I like
Great question, Karen.
Thank you.
Love it. Yep.
Bill says, if China loses access to our markets, will they sell our bonds? Yeah, absolutely. And the Treasury will buy them all. The Fed will just put it right on the balance sheet.
Great question too, Bill. Nice. Got good question flow going.
Tom,
Good morning.
how's it going, Tom? Oh boy, now that Tom's got me on Pomp, he's been sending me a lot of study materials.
Ready to take a look at and see. Press a YouTube.
Tom, your audio is coming in and out, muffled.
I think you might be moving your mic, Tom. You might want to keep it still.
Oh, okay.
There you go.
Okay. Preston Fish, Pysh, in an interview with Mark Yusko, Yusko. I think it was yesterday. And I find them to be in gigantic correlation or agreement with you. And I wonder if other people find that too.
Okay, I'll definitely try to check those out. I'll give you guys a little look at how much studying I do, just for a feel. I'll pull up my YouTube history. Yeah, and if you have more questions, guys, feel free to. So let's see. So here's just some of the content I've looked at in just the last 24 hours or yesterday. So a lot of, if you got to realize to do my job properly, I have to be willing to listen to information I think is incorrect sometimes, to get viewpoints from different actors, some which I may agree with, some which I may disagree with, but I always want to have as many different viewpoints as possible so I can try to get as close to the truth as possible. So in the boot camp, a lot of the stuff you just won't ever see. I'm really pulling out the most valuable pieces that I can and giving those to each Tuesday. So I've got this guy's trains nurses for a living in his previous career, doing a daily video. This is some sort of crazy political fellow who has a huge following on YouTube, who I've found interesting for certain types of mentalities. This guy's a doctor. He gets into the nitty gritty. He actually works in ICUs, so he's on the ground seeing this play out. Wall Street for Main Street is a fellow who's on top of China, extremely on top of China. Paul Control, I kind of call a tinfoil hat fellow, but he's been quite accurate. Northman Trader, who's one of my favorite technicians I listen to. Stephen Henrich, he's on TV quite often. Every once in a while, I listen to a little Joe Rogan. This is a new one for me, Stefan Molyneux. He's got a premiere coming out today that's supposed to be really good. There's quite a bit of people who, this fellow, for example, as well as this fellow, and quite a few are trying to pitch that this is being overblown. They're trying to take away our civil liberties. We need to just go back to work and let this just run through the population. There's quite a buildup of audience. spouting out that the cure can't be worse than the disease. So I definitely listen to those points of views. Unfortunately, I just don't think that's going to work for political leaders to be reelected, which you got to think, what's the purpose of each person in their role? Anton Petrov, this guy's a little science geek. I've got some crazy preppers I listen to are always really, they seem to be mostly tuned into the food supply, which is interesting. A lot of the food supply is currently being shut off. CNBC, Fox, I rarely listen to some of their stuff. China in Focus definitely has a huge slant on being anti-China. That, you can see they call it the CCP. Then there's certain political figures that I listen to every little word that comes out of their mouth, who are good leading indicators for what comes next. The Treasurer, Peter Navarro, Attorney General Barr, for example, are three of those. This John Campbell I listen to religiously daily. If Bill Gates speaks about this, you better listen, whether you think he's good or bad. So just, we're barely to Saturday, and that's probably 10, 20 hours of content just right there. So I'm listening to a lot of different stuff to try to get a good, I like to listen to macro voices, but I also am trying to get a better understanding of actually the virus itself. So that's what really, after really studying this, has made me understand there's really only one solution to this. Is it's on and off. You got to go in and out of some sort of lockdown, but that costs you your economy. So then you try to get your economy back, and then this starts to ramp back up. So it's really what gets us stuck in this predicament that there's really no solution. And the hopes for a virus is really, 18 months will be lucky if we get a virus by then. Okay, so I kind of rambled on that, guys, but just want you to understand that I do go through quite a bit of information to try to figure out what's really happening. Any more questions out there?
Okay, Jason, and I did post the testimonials link in there. And guys, I'm sorry, but Zoom as of last week doesn't let us post links to the chat box that are live. So you'll just have to copy and paste that link in there. Just copy it and paste it into your browser, and then it will open it up and display the pages that we sent over to you. Okay.
All right, guys, last chance to speak or post a question. Tony Layton, go ahead.
Okay, yeah, I was just wondering if you guys would comment on, appears there's a volume tapered off somewhat in the TLT and in the bonds in general. Is that you're experiencing?
So here's where we track the supply of treasuries right here. So supply is increasing, not decreasing, for sure. The TLT, remember, that's kind of like a kid's game for just a tiny piece of the treasury market.
Right.
And let's pull up the yield curve here. This is a list of the. This is probably one of my favorite things to do is just to go through the course of time. If you look at the yield here, you'll notice with that exception, it just slowly goes lower, 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 lower. So lower this goes represents a greater demand for the debt outstanding. And the higher it goes represents lower demand for the debt outstanding. And so the short-term move has been from at least this, let's just see for this year what we've seen in terms of supply and demand. Oh, that's last year. So we know the supply side of the debt market's growing, right? But is the demand for that debt growing at a faster rate? And that's really our bet, is that the demand for the debt will grow at a faster pace than the supply. And we know in a normal world that wouldn't be the case. Normally, if we grow supply, then we'd expect that the demand would decrease, right? But the way we have with our Fed creates the exact opposite. So we started the year at 2.3. And we hit 1.8 by February 25th. This is the highest level of demand we've seen. Traded to 0.99. That's when that 180 spike on the TLT hit. This is also when every central bank in the world had a huge loss in the stocks, oil markets. They all had to sell their treasuries and try to support their stock position. So we saw the yield spike up to 1.7. And now it's back down to 1.3. So in general, I would tell you that the demand for the 30-year treasury over the course of the year has been nothing but increasing in demand and not decreasing. And that's at a time where we know that the supply side is going to dramatically increase. Now, they haven't increased the supply side on that 30-year yet, but they will, because there's $2.2 trillion stimulus plan, and they want to put it all in the 20, 30-year category. So it'll take some time for them to do that. And yeah, so I wouldn't focus on retailers playing the TLT for volume levels on the bond market. But if you want to look at this page, you can see if increase or decrease in demand is apparent with this chart. And remember, this is just tiny. This is like the 30 years, sort of like your Patron tequila, and we got the well tequila everybody else is drinking over here in the T-bills. So this is really the cream of the crop in your bond products. But yeah, when you have stocks going up 30% in 3 weeks, that's going to cause, it's not going to make demand for bonds go up. It's going to attract people to go chase that stock rally. So we've seen a little, considering the bounce in stocks, I would expect this to have gone to maybe 1.5, 1.75, and I still wouldn't have changed my positions. So the fact that stocks could rally this significantly and the bonds haven't budged is very, very telling. It means the people who own these bonds are holding them hostage no matter what. They're not letting go of their bond position. Okay, Tyler G says, tempted to get 2 times on the Forex trade, even though I'm at 75K. Yeah, I like that trade. I don't think you're going to be hurt by that. So in that trade, Tyler's talking about shorting the Hong Kong dollar. And again, the same play for FXI is the same play for I think FXI will crash first, and then at some point the opportunity for China to ditch Hong Kong occurs. But that could be, we could be holding that position for a while. So if I were personally doing it, I would have equal investment in FXI put as I did in at least in the margin I'm using on the Forex trade. So one we could make 30 to 1. The other we can make 100 to 1.
So what do you foresee the time frame on that?
On which trade?
On that Hong Kong dollar? Shorten that.
So yeah, I think that the US is going to start putting sanctions on China. And I think they'll slowly but surely ramp those up. And at the same time, they're going to fail to make their. So I want to find this in the actual text, but Daniel D. Martino had a good interview with that value team, and she's always doing interviews. She says the same stuff over and over. But she points out that the phase one trade deal had an exit clause if there's a pandemic or essentially an act of God that makes it so they can't afford to meet the deal, then the deal's off. And so they signed that deal and put that language in there as they knew this was turning into a localized problem in China. So they had cases starting December 1st with human-to-human spread, and they're jailing the doctors trying to whistleblow it. So they knew they're never going to do phase one, is my bet. So phase one fails. Trump starts putting sanctions on China, maybe raising tariffs, and eventually the real big move would be to revoke the special status of Hong Kong. And that's when you really break Hong Kong's back. So I think FXI will have a profit when our puts on the SPY do. And then leading into that, potentially we take such extreme measures to revoke Hong Kong's special status, which is where they have their stock exchange. So those are really correlated, but I do expect FXI to play out first, and then eventually the Hong Kong dollar peg breaks. So timing, a good chance they do it leading into this election, great chance they do it after this election. Also, it's important to remember that phase one was just sort of reorganizing where China buys stuff from, which would be good for us, bad for all their trading partners in their region, and bad for their goal of having positive relationships and expanding their boundary, which is really China's goal. So I can understand why they don't want to do that deal. Phase two is absolutely out of the question. Phase two is asking them to restructure their government to not subsidize key industries, which is their advantage. That's the whole advantage of their government structure, and gives them an unfair advantage. Really, China can go into any sector they want and take it over because they're going to tax the whole country and then put all the resources towards that one single sector, which is unfair. I told everybody green light for that trade Thursday, Murray, but I'll put out an official written trade alert tomorrow, Tuesday, for Bootcamp, so you can see it written out, and I'll clearly identify how much to put into it based on portfolio size. And Friday we were off because of Good Friday. So yeah, really what we have, guys, is 6 months minimum of really bad economic data, bad earnings, bad revenue growth. So that's why we want to be short stocks. And then we have at the same time, the government's going to start trying to raise the money for all these promises we've made. So in the short term, they simply literally quadrupled the size of the T-bills, but they got to roll this over they literally roll this over every week. So they don't want to expand the debt on the T-bills. They want to expand the debt on the bonds. So I think as they began moving it from T-bills into notes and bonds is when the long-term investment has to be made, and when we're going to start seeing the really good times for the TLT. In terms of timing, $2.2 trillion just from the stimulus bill. Okay, so that's going to take at least 2 years to fund. We were already running a $1 trillion deficit, and that's with unemployment at all-time lows. So now you're going to have unemployment near depressionary levels. So the deficit's going to just get blown out. It's going to be trillions and trillions per year that's being sold through this vehicle right here. So it has to start very soon, and it's going to last a very long time. And the entire time that we have to run these massive deficits, I'd expect very miserable returns in stocks. And again, outside of perhaps a handful of small sectors that will really benefit from the government debt we're selling. And to be clear, I do expect a crash into the summer. Then we reemerge with mass. It looks like things are halfway decent. We open the economy and then we realize that's not good enough. And then we get another crash into 2021. So we'll be playing it accordingly in terms of our stock position and trying to get into the only reason I would want to buy this summer, expecting potentially 2 waves of down move, is I do believe we'll get in for a good discount. And then after a big rally, we're going to buy that in the money put to protect us into 2021. So we're starting the counter for having a year hold position so that we can let these go in 2021 for big profits and then start looking at what sectors we want to rotate into after that. So I'm trying to make sure everything's tax advantage for you guys. So that can be accomplished buying assets and using the married put. So we'll have to realize profits on the puts if we're right with the short-term gain. But the bigger position, we can hold for a year and get into the lower tax bracket. So the sooner we can do that, the sooner we have flexibility to rotate out of one ETF into another and have the lower tax obligation. Now, if something happens and this is short-lived, great, but I don't think this is really going to be fixed in 2020, unfortunately. All right, any last questions? Well, I think we had about 90 at one point. We still got 50, so we kept over half the crowd for somewhere over 3 hours. So thank you guys for investing your time in our content today. I want to applaud everyone for having the patience to wait for these trades to work in our favor. And also really appreciate everybody providing chats and questions. Always appreciate that. John says, is there any way to protect real estate value? So yeah, the real estate at first I thought might go up, but now it's quite clear we're going to have everybody under the sun not paying their mortgage, not paying rent. So that's not good for real estate at all. So yeah, I'll have to look at ways to protect your house value. That's a good question. Randy says, why is TLT falling so much? Well, it's only down 0.63%, so that's not a lot in my book. But yeah, here's the giveaway that we're in the right position here. Let's just zoom in on this.
It typically takes a day or two to start reacting with the inverse reaction of the market too.
Yeah, so you got stocks going up. Stocks went from -35 to -18. So you have about a 20, just under a 20% move up. Okay, so from this same point, what did the TLT do? It's flat. Okay, it's down 2% from that same point. So usually it's about a 2-for-1. So usually if the SPY goes up 2%, your TLT is down 1%. And that's not happening. So what's happening? Insiders of the companies are selling their stocks. They're using corporate buybacks, which the Fed funded to get out. And they're buying up bonds. Everybody knows bonds are the best investment. Who's on the inside? Mark says first deflation, then inflation. So real estate will go down and then up with useless dollars. I would agree with that. I think you'll have a short-term buying opportunity in the next 12 months to get real estate at a discount. And then coinciding with a big run up in gold, you'll see everything inflate. And then the Fed has to hike interest rates and it destroys the value of everything. That'll be really how we protect the dollar and the biggest weapon we have. So I think they're going to, that'll be the hydrogen bomb for the markets, is to hike interest rates and blow out all the bubbles. All right, guys, we'll go ahead and wrap up
Did you
today's.
see that question from Marlene?
Oh, let me see.
Yeah, she just started on Thursday, Jason. So she just, and it was after the market closed. So she's just wondering what she needs to put on today.
Oh, okay. So you're doing the buy and hold, right?
Basic.
Oh, basic.
Yeah, with 30K.
Okay. So I would delete these two here for 30K. So this is your only move today.
So and that's the bottom two, Marlene. Yep.
And then you're going to sit back, wait for this crash to occur, and then we're going to convert your
That was
cash.
the top three, not the bottom three.
Top three keep, bottom two delete if you have 30K. So these three we're keeping. The short-term ones would be more useful to you. And again, I do anticipate around August or September, we'll be able to buy up these ETFs at about half off. Logan says banks aren't lending money. They're putting I saw that headline, the 700 credit scoring 20% down. Yeah, so real estate market could be in some pretty serious problems. Shiraz says, thank you, Jason Dean. I'm a happy camper. Thank you so much, Shiraz. Randy says they're buying Amazon and Tesla. It's going wild. Marlene says today, bottom three, the ones that aren't displayed now, right? Top three, yes. Okay, good. Okay, very good, guys. So, yeah, so Amazon's having, what's the short term? Everybody rushed out and bought a ton of shit. What's going to happen next? Well, now you're out of money. You're not going to buy anything. You don't have a job. You're going to go look for, we didn't even get to go through my news today. Dang it, I forgot about that. Well, one of the videos I have is in Los Angeles. The food lines are getting ridiculous. Look at that. So Amazon might do good for quarter one, but I bet you quarter two is not so hot. Not with a third of the, you gotta realize if a third of your labor force is unemployed, then everything has to be revalued much lower. If income for 75% of Americans is dropped 25%, you have to reprice the whole thing lower. So, yeah, we got 6 months of bad times for equities ahead. And mainly because they're proving the lockdown method works. If they remove the lockdown, this spirals out of control and we end up right back into lockdown. So my expectation is the overlords that I call it, the bean counters, they understand how to lose the least money to lose the least money, you do a hardcore shutdown and then get set up to track this better. So you got to have extreme testing. Everybody has to have either a green light, means you've already had the disease, you're good, you've got antibodies. Red light means you're sick, you better be thrown in a quarantine because you're going to get everybody around you sick. And then orange light means you haven't had it yet, so you're still a high risk of becoming contaminated. So I think we're going to have extreme testing when they do open back up. Everyone's going to wear masks. They're going to have to try to find people when they get sick super early on so they can go do contract tracing. So anybody you communicate with, so all your household and all their, it's pretty crazy how fast you can see the circle of connections between people. So yeah, if we do a 60-day lockdown, you're going to reset the clock. You're going to have way less cases to deal with, and you'll be able to open back up the economy for the longest period of time. And then with proper testing facilities and really aggressively finding the cases as they pop, quarantining these areas, you can get away with at least having some economic activity. If they open this back up in May, it'll be a disaster. And that would make me even want to get more aggressive with our positioning than currently. Tyler G says he sells products on Amazon, and they just opened up the ability to ship more non-essential items. So that initial flood of people trying to rush and buy stuff, I think, is hit. And so I'd be weary of buying Amazon at current prices because of that, especially after they'll probably have a blowout Q1. But will Q2, Q3 be so hot? It will be relative to other competitors who will be bankrupt. But relative to Q1, I think it'll be much lower. So that's why we don't want to buy. I'm not predicting revenue and growth for really any company comparing Q1 to Q2. It's $1,000, Tyler, for one mini. That's what you're going to need. And then maybe add an extra $100 in for your swap cost. Sue says, turn the volume louder. Yeah, sorry, I could definitely get that closer. Is that better?
You're good.
Okay, good. All right, well, let's go ahead and call it. Very good. Thank you guys for joining us and staying live. Still got 49, went another 15 minutes. So you guys, very good students, very good participants, highly appreciated. And we look forward to our next webinar Wednesday. Tomorrow, I will send an update out for every product, letting you know everything is still good, no changes. If there is anything of an emergency level, I'll issue that trade so you know what to do. If you're in the boot camp, I'm going to give you some good videos. We've got a Ray Dalio piece, very good. We have also a Daniel D. Martino hour-and-a-half interview that was excellent with that fellow Valuetainment. I do like his interviews. You can tell he's getting nice and upset about China. And then I'll likely pick out 3 to 5 more that are very useful for current environment. So thank you guys so much. And we look forward to having an update to you tomorrow. Make sure you know what's going on in your portfolio. Bootcamp will get content tomorrow to study. I might release your new spreadsheet. And I'm also potentially going to get a new spreadsheet video done tomorrow. So hopefully get that out. And Wednesday will be our next trading webinar and alert. All right, Ryan, let's go ahead and close the show. Thank you guys. Thanks, Dean. Thanks, Ryan. Thanks, everybody.